SIRC of ICAI organizing another virtual CP meeting on insights on tax audit, a close-by-close analysis of Form 3CD and issues in tax audit. We have today's speakers CA Vedant, Parikh and CA Nimisha Jain joined from Ahmedabad. May I request our chairman to welcome our speakers for this afternoon and all the other participants here. Over to you, sir.
The resource persons today, CA Vedant Parikh and Nimisha Jain, very respected seniors, colleagues and friends in profession. My fellow colleagues in Managing Committee, today, ICAI Ernakulam branch welcome each and every one of you to a tax audit seminar, which is named as Insights on Tax Audit, a clause-by-clause analysis of Form 3CD and issues in tax audit. After the lockdown and gradual easing of restrictions, we are getting back to our routine work. Every one of us might have started work on tax audit and probably completed company audit. Tax audit might be in progress. Today we are presenting, as I mentioned earlier, one of the most important topics in direct taxation. That's in tax audit, an analysis of Form 3CD and the related issues in tax audit. Of recently, many changes are brought in tax audit provisions affecting Form 3CD reporting and making tax audit reporting more onerous and responsible. The learned resource persons today, as I mentioned, is CA Vedant Parikh and CA Nimisha Jain from Ahmedabad, young and dynamic, enterprising resource persons. I am quite sure that today's discussion will throw more light on various amendments and changes brought in by the government and enlighten and update the participants' knowledge. On behalf of Ernakulam branch of ICAI, I extend a hearty welcome to the resource persons today, CA Vedant Parikh and CA Nimisha Jain to this webinar. Welcome, CA Vedant Parikh and Nimisha Jain. Let me also welcome all the colleagues and seniors and friends in profession and the MC members present here today. Immediate past Chairman Srinivasan, Vice Chairman Tinjit Warrior, Secretary Jos KV, Treasurer Deepa Varghese, Sikasa Chairman Alan Joseph, and Committee Member and Study Circle Coordinator Salim, all to this webinar. Hope you will have a wonderful learning time today. As usual, before passing on the proceedings, few points. If you want to raise question, you can raise it in the Q&A box. Q&A box is beside the chat box with a question mark or in the box which is having a three dots. Don't mix your general comments with the questions. All the general comments can be posted in the chat box and the questions in the Q&A box. And if the member wishes to raise the question directly to the resource person, please inform us or express it in the Q&A box, and you will be called to raise the question in person at the appropriate time. CP credits. Every time we are mentioning that physical presence and attending the seminar is essential, is a must for availing the CP credit. Many of our friends, I think, believe that by registration alone, they will get the CP credit entitlement. I am really sorry. I will be helpless also. We will be helpless also because the CP Directorate is asking for the attendance report generated from the web platform. So you need to be here not only by registration through registration, but through your presence also and attend the seminar. Some friends are coming at the last moment of the session. Sorry, please avoid that. Enter early and be there and get the credit. That's all I want to tell you. Hope this session will be a wonderful session for all of you. That the schedule of the session will be briefed by the resource person himself. I think he will be taking up the question answer after the discussion only. Once again, wish you have a wonderful learning time here today. Thank you for the patient listening. Over to Jos for further proceedings, please.
Thank you, Chairman CA Roy Varghese. May I request our Vice Chairman CA Ranjit Warrior to introduce speaker of the first session, CA Vedant Parikh.
Very good afternoon to all of you. Very happy and proud to be indeed presenting before you the young and passionate Chartered Accountant CA Vedant Parikh. He is a certificate holder in concurrent.
Ranjit, your video is off. Ranjit?
No, it is clear now.
Video is clear? Video?
Yes, clear.
Forensic accounting and fraud detection. He's got experience in audit and assurance, specializing in banking and real estate industry. He's currently the managing partner to the firm, plus he is formerly an associate with Messrs. Talati and Talati Chartered Accountants LLP, pioneered by our former past president of ICAI, Mr. Sunil Talati. CA Vedant Parikh also expertise includes in the area of forensic audit and commodity exchange related compliances. He is also currently the professional independent director of the Godhra City Cooperative Bank Limited. He is currently pursuing diploma in systems audit visa and valuation degree from ICAI. Vedant is an empaneled speaker with WIRC of ICAI and regularly presents papers and also been part of various webinars of ICAI, Connect EC, Mahaseva, EDXL, etc. Let me with these words once again introduce before you CA Vedant Parikh.
Over to you, sir.
CA Nimisha Jain, an ACA. She's also having a BCom graduation. She's currently practicing as a chartered accountant and associate with VCAN and Company, prior to which she was working with Deloitte and PwC. While at Deloitte, she's handled various statutory as audits and limited review assignments of varied industries such as textile, pharmaceutical, oil and gas, etc. And while with PwC, she has handled various assignments of compliance, assessment, and advisory in the fields of transfer pricing. She was an All India rank holder at intermediate level and was awarded with a gold medal by CA Association for securing the highest marks in the subject accountancy at CA Inter level. She is also a recognized speaker at the JCAF platform. These are the words, simple words to introduce our Nimisha Jain, dynamic chartered accountant.
Analysis and real apology for technical issues that we are facing, and my co-speaker Vedant is not able to join, and he'll be joining soon. So we had decided to bifurcate the topic as to basics and applicability of tax audit, and secondly, what are the clause by clause impact that that a tax auditor needs to give. That was to be covered in the second session, but now we shall start with tax audit clause by clause analysis, and I'll try to cover the part A portion, which is pretty simple one, and just informatory clauses are covered therein, and then we will try to cover up the applicability of tax audit. So to start with, Clause 1. It is the name of the assessee. So clause is pretty simple, but the question comes, what should be disclosed as name? Name is whenever it comes to an individual or a sole proprietor, partnership firm, LLP, or the company, the name the name clause demands the name has to be the same with the income tax records. That is, the assessee whose accounts are being audited under Section 44AB must disclose the name which on which the same which is present in the income tax records. So if there is an audit of branch, the name of the branch should be stated along with the name of the assessee. And if there is an audit of a sole proprietor, then the name of the proprietor must be stated along with the proprietary concern's name. Same way, when there is a change in the name of company, or there is a conversion from public limited to private limited, or vice versa, or conversion of company to LLP, then both the names should be stated in the name clause, and the fact that there was such a change in the time period covered under tax audit must also be stated. Secondly, when there is a change in the name of assessee, when we see it from the period perspective, that as on the last date of my financial year, the name of the assessee was X, and as on the date of the tax audit, the date of signing the tax audit must, just a minute, the date of the tax audit, then both the name should be given in the notes and in the name clause as well. Clause 2. Clause 2 is again address clause. Now, just as we understood that in the name clause, if we are auditing a branch, then the name of the assessee and the name of the branch should be given. In the same way, when we are auditing the branch, the address of the branch should be stated, not the main head office addresses. And the address should correspond to the address which the assessee has used for the correspondence with the income tax department. That is, if your registered office address is X and the income tax department is using the address, that address for the correspondence with the assessee, same address should be stated on the tax audit report and not the factory's address or something else. If at all we want to give another address, but the main address must be given. Second thing, in case of change in address after the end of the financial year, but before the date of signing the tax audit, the same fact should be brought on Form 3CD. Means there should not be any hide and seek with the address as well. Because if you're giving address as on the last date and the address as on the date of signing the report has changed, then the same status has to be brought into picture. And many a times there will be a case that the address of the registered office will be in city X and the principal place of business may be in the city Y, and the tax auditor must be doing all the work and gathering all the records for disclosure from city Y place of business. In that case, registered office address has to be stated along with the principal place of business. So the entire heart of this clause is using the address which is registered with the different authorities. Why we are emphasizing again and again on registered office? Because address of registered office, may it be firm and then it will be registered with the registrar of firm, may it be company, then it will be registered with the registrar of companies, and the address which you are given to income tax officer via tax audit report, they should all coincide and there should not be different flaps of addresses. Clause 3, permanent account number. This is nothing but the tax audit report demands the disclosure of permanent account number of the assessee, and it is mandatory to provide this. But now, as a tax auditor, we should always take care, we should always be mindful of obtaining the PAN card copy from the client before mentioning the PAN number. Clause 4. Registration numbers under applicable indirect taxes. Now, after the introduction of GST, our indirect taxation purview is limited to GST and customs. But before GST, when we used to have different regimes such as excise, service tax, or VAT or CST, in those cases, the assessee was required to obtain different registration number and the same way to be disclosed while giving tax audit report. Now, even after GST era, there may be cases that service tax audits or assessments are going on, and in that case, if the assessee has not surrendered the such registration numbers, then the assessee is required to produce all such registration numbers of indirect taxes in their Form 3CD. And as an auditor, what we need to take care, that is very much important. Why? Because understanding the entity and the environment in which it is operating, we must be knowing what all kinds of indirect taxes are applicable to the entity. But still, it is very much important for an auditor to obtain the list of indirect taxes applicable to the assessee from the management, and the written representation in this regard, that the management is aware all those indirect taxes are applicable to the assessee and what all registration number it has obtained. And there may be a case that auditor prima facie believes that indirect tax law is applicable on the business or profession of the assessee, but the assessee is not registered under the said law. Then, as an auditor, the duty of the auditor to report such discrepancy by the notes, and such fact should be brought upon on the 3CD. Next clause, that is clause 5, status. What does that mean? Residential status? Not really. It means the status of the person as given under Section 31 of the Income Tax Act, wherein 7 statuses are represented: individual, HUF, company, firm, etc. And now, firm for the purpose of this clause will include LLP, but LLP that is incorporated outside India, that is foreign LLP, will be considered as body corporate. Secondly, if status of the assessee have been changed during the year, just as we discussed in the name clause or the address clause, wherever there is change in the status, and change in the status with respect to time, that is date as on the last date of the previous year, or the date on which tax audit report is being signed, then such fact has to be brought upon. And the status as on the last date of the previous year should be considered for the purpose of reporting, and this fact should be again mentioned by way of note against the clause. There is a landmark judgment on this clause, which is very simple, because as we all know, AOP or BOI means association of persons or body of individuals. These are the entities. Yeah, these are the entities which are brought into the purview of income tax. And yes.
Audible?
Yes, Vedant.
Yes.
So coming back. So association of persons or body of individuals, whether incorporated or not, as we all know, company, LLP, they are having separate legal existence than the individual himself. But when we talk about association of persons or body of individuals, the legality, the separate legal existence comes into questions. Now, whether they are incorporated or not has to be brought within the net of taxation with the intention clearly to hit
I think
this is worth to refer to this judgment. Why? Because when we look for association of persons or body of individuals, nobody will really come to know whether along with my 4 friends are coming and doing business, right? But whenever this kind of arrangement is there, the income tax will cover this as a single tax unit, and this is covered in this case law named Mira and Company versus CIT. Any profit yielding joint venture, may it be as an association of persons or body of individuals, will be taxed as a single unit. Clause 6 and Clause 7, pretty simple, previous year and assessment year. That is nothing but Clause 6 talks about the financial year pertaining to the audit, and we need to mention the previous year for which tax audit is being conducted. Clause 7 talks about the assessment year which is relevant to the previous year. Clause 8, applicable tax laws triggering the tax audit. I would request Vedant to take up from here because then there is
We have to suffer in the time barrier. So directly jumping to the topic, India being known as the land of laws, there are multiple laws instated in the constitution since ages. Thanks to the present government who is making all the efforts and leaving no stone unturned to make the laws in Indian society to be more useful. Having said that, income tax is one of the such laws where our profession revolves around. Albert Einstein, as we all know, is one of the greatest brain the universe has seen. So Albert Einstein once said, the hardest thing in the world is to understand the income tax law. So today, with the help of the chairman and the entire managing committee of the Ernakulam branch of SIRC of ICAI, I, along with my co-speaker Nimisha Jain, has been given the opportunity to share the thoughts, insights, and discuss about the topic which will be picked from this month till the end of November, that is tax audit. Yes, participants. So I'd like to thank and congratulate the Ernakulam branch for organizing such a wonderful webinar on this topic, which will be useful to the professionals at large at the right point of time. I would like to acknowledge my personal thanks to Mr. Roy Varghese, who was behind me to ensure that we give our best so that the participants can take best advantage out of the webinar. With this brief set in the motion, let's begin our today's topic, friends. Today, it takes more brains and efforts to make out the income tax form than it does take to generate the income, as it is said by Alfred Newman, and I rightly appreciate that quote. Today, the topic for the session is the insights and tax audit, which has been spoken by my previous in the previous introductory part, whereby the chairman sir also gave the thought process on the topic, and I thank for giving such a beautiful introduction for me and my co-speaker. So let's begin with the presentation, participants. So in this participation, as Nimisha was rightly stating, that we have bifurcated these 3 hours so as to make it as interesting as possible for all the participants, to ensure that the participant gets all the due advantage from this webinar, and which will be useful to them in the practical due course. So we have bifurcated the presentation into 3 parts. First part being the applicability of tax audit. Secondly, in an hour or 1.5 hour, Nimisha would be taking up with regard to the clause by clause interpretation of the Form 3CD, whereby the due importance has also been further bifurcated into 3 parts. The first being the coverage of the total 41 clauses in the Form 3CD. Apart from that, the importance of ICDS, that is income computation and disclosure standards, and some of the important clauses which are there in the Form 3CD, which will be useful at the time of filling your Form 3CD. So after that, in the last 15 or 20 minutes, I'll be taking the session as a summarized session to brief you all about the key takeaways and the points to be taken care at the time of conducting tax audit. Yes, friends. So let me begin for my and our session, where we'll be covering briefly what is tax audit, what are the eligibility criteria, what is presumptive taxation, a very important concept, due dates, that what are the different due dates that has to be taken care while fulfilling our professional responsibilities. The structure of tax audit, that is very important, friends, that I have bifurcated into 2 parts. First being the report, and the second being the statement of particulars, and the procedure for submission of that tax audit report, and failure, if any, what kind of penalty will be levied for the part of non-compliances. Yes, friends. Just a second. Necessary. Whenever we are starting audit, it is not a simple process whereby we'll simply start that client has came, the tax audit is applicable, or whereby we see the conditions and we state that yes, the tax audit will be applicable to this assessee and we shall carry out this process. But wait, apply a thought. As it is said that planning is a backbone for any exercise, event, or an activity. In the similar manner, to understand and plan in a proper manner that how to execute, carry out, and evaluate what is tax audit is equally important. So to begin with, what is tax audit? To understand in a layman's term, it is the examination or review of the accounts of any business or profession carried out by the taxpayers from an income tax viewpoint. Here, the importance is being given to income tax viewpoint. It is quite natural that the audit is being conducted under the Income Tax Act. Hence, the importance is given with reference to the income tax viewpoint. So this audit has been made applicable via section, that is section 44AB under the Income Tax Act 1961. Yes, friends. Moving ahead. Now this audit is applicable to any business or profession, as I said here. So what is the category or list or nature of business or professions that are being involved in this? Because as we all know that in the terms of income tax, taxpayer is being recognized in the name of an assessee. A unique name is unique identity is given to the assessee by the way of PAN. So that is the identity of an assessee. Assessee can be in any form. So these are the forms. I have taken an example whereby in business, as you can see, there may be sole proprietorship, there may be LLP, there may be private company, there may be public company, or there may be joint venture. If on the other hand, if I talk about the profession, there may be engineering, legal, architectural, accountant, medical, technical consultant, interior decoration, and the list is so on. So this is just to give a brief that what all nature of activities or assessees are being covered under the business head and the profession head, because this becomes very important when we are going to check the eligibility norms for an assessee under the requirement of section 44AB. Yes, moving ahead. The eligibility criteria, as I was stating, that in India, as we all know, or anywhere, for any person or an assessee to fall under this section, there is an eligibility criteria. So in the similar fashion, under section 44AB, during the year, for this year, a change has been noticed. Previously, as we all know, the tax audit limits was linked to the turnover, whereby if the turnover of an assessee exceeds rupees 1 crore in the business, then the tax audit is applicable. Yes. Then what is the change that has impacted during the current year and that will be applicable to you while carrying out the tax audits? So it is stated that a taxpayer is required to have tax audit carried out if the sales, turnover, gross receipts of the business exceeds rupees 5 crore in the financial year. Here, when I'm talking about financial year with reference to income tax, it is the previous year for which the tax audit is being carried out. However, a taxpayer may be required to get their accounts audited in certain other circumstances as well. So what does I mean by that? On the first statement, I am stating that if the turnover exceeds 5 crore rupees in business, then you are supposed to fall under tax audit. On the second statement, I am saying that apart from this, also there are certain conditions. If you are fulfilling that, then you are supposed to carry out tax audit. So these are two bifurcations. Let me first take you through this. First, where the turnover criteria of 5 crore is there. So it is simple, as previously it was 1 crore limit. Now that has been increased to 5 crore, 5 times growth. Why this change has been brought up by the government? So please try to understand, friends. As per government's record, and as you all might be knowing that recently, Honorable Prime Minister Narendra Modi ji also stated, while on the, I suppose on 13th of August, that while introduction of the faceless assessment and appeal scheme, at that time also Shri PM noticed and stated the fact that in a population of around 130 crores, tax returns of the people who are paying the tax, the numbers are only 1.5 to 2 crores. So you can imagine the quantum of the population that is there in the country against which the population which is actually paying the tax. So that is roughly around 1.5 to 2 crore. So now, if we again bifurcate, if we see this data at a micro level, we'll able to analyze that the higher turnover percentage, higher turnover generating assessees are paying more tax. That is quite practical enough. So with that intention, because what was happening that if an assessee is generating a turnover of 1 crore, it was a kind of burdensome. I would not say it as an harassment, but it is a burdensome exercise, because that may be a small vendor, that may be a small provision store holder, A small person, because carrying out at a proper place, 1 crore would be the turnover, but the profit would not be that as it would be seeming. So to curtail all that procedure, the government has increased the limit from 1 crore to 5 crore, by way of which a great relief would be provided to the people at small and lower society, so that maintaining a compulsory books of accounts and all that procedure will be taken out. So now, discussing about this 5 crore limit, what the change has been brought in. So now that limit from 1 crore has been increased to 5 crores. I can see 5 times multiplication increase. Now that is not the simple condition this time, dear participants. Two important points that has been described here, which is very crucial and important. That is, first, the taxpayers' cash receipts are limited to 5% of the gross receipts or turnover. Mind well, 5% of the cash receipts, that is inward of cash, is limited to the total of 5% of total of gross receipts or turnover. Is this a condition only? No. On the second side, it is rightly mentioned and. So what does that and state? On the other side, it says that if the taxpayers' cash payments are limited to 5% of what? Of the aggregate payments. So now it is like a balance card, whereby you have to check that first condition is whether your turnover is exceeding rupees 5 crores, yes or no. Further that you have to check the tax audit applicability if the cash receipts on the one side and the cash payments on the one side, as I explained, is within the limits and the turnover is below 5 crores, then friends, you're out of tax audit. So this is the 3-point subject condition criteria for the eligibility falling under the tax audit. So this is clear. Moving ahead, the presumptive taxation. Now this is very crucial and important, not being part of the topic, though I have covered. The reason being, the other part which I'll be discussing is purely dependent on the presumptive taxation, and if you're not aware about presumptive taxation, then it will be not easy to grab or understand or absorb the PPT. So presumptive taxation, there are various sections under this taxation ranging from 44 AD to 44 triple B, where the sections like AD for business, 44 ADA for profession, 44 AE, double B, double BA, triple B, I'll be discussing as well. Don't worry about it. So let me begin, participants, with first section, that is section 44 AD. Now this section is for business. As you can see in the first bullet, section 44 AD is applicable for the businesses that are covered under 44 AD of the Income Tax Act. Now, what is 44 AD and what are the benefits or what are the criteria? So let me first start with the turnover criteria. It states that any business which has a turnover of less than 2 crore can opt to be taxed presumptively. So this becomes your eligibility criteria. So that states that if an assessee whose turnover is less than 2 crore rupees, then yes, you can opt for presumptive taxation. Wait, then what are the benefits? Then the condition states that they must declare profits of 8% of non-digital transactions. When I am stating that non-digital transactions, I mean by way of cash, or 6% for digital transaction, whichever one is applicable. So to understand it, I'll give an example. I, being a businessman, if my turnover is up to 2 crore rupees, I have an option to go for normal taxation. As I can see that the criteria of 5 crore is there for tax audit. So, okay, Tata, bye bye, see ya. I'm not falling under that. So now there is two options, file normal return, or I can go for presumptive taxation. So what is the benefit available under presumptive taxation? So presumptive taxation, the first condition, as I'm saying again and again, the turnover is restricted to 2 crore rupees. Then I have to offer to my income what? 8% of my turnover directly as tax if I am dealing into cash transaction for the proceeds of the business. Or if I'm using banking channel for the purpose of accepting receipts of the business, then it is 6%. So straight away, if your income is 100, multiply by 8. So 8 on 8, the tax rate will be applicable and that becomes directly your taxable income. On the other end, if it is digital, then it is 6%. As it is stated, there are exceptions to this adoption. Life insurance agents, commission of any kind, or running the business of flying. If any of these three activities are carried out by you, you are not eligible for opting under Section 44 AD. Now, why I as an assessee would opt for 44 AD would be a normal question. I'll take that after this slide, but let me give you an example that how does this 6% and 8% work. So say for example, as stated on the screen, ABC Enterprise have gross receipts of 1.5 crores for financial year and do not maintain books of accounts. So that for that purpose, ABC Enterprises has opted for presumptive taxation. Don't worry about it. I am explaining at a later stage. Second point, during the year, ABC Enterprise received 70 lakhs through non-digital transaction, that is cash payments, and rupees 80 lakh through digital transactions. Then what will be the income under the head business and profession? So as I stated right now, income under the profession would be, there will be bifurcation between 1.5 crores. The 70 lakh will be applied at a rate of 8%, and the remaining 80 lakh would be applied at a rate of 6%. So as you can see, the answer from 8% is 5 lakh 60,000, and for digital transaction it is 4 lakh 80,000, totaling to 10 lakh 40,000. This will be your income offered for taxation. So this is just the interpretation, correct? Now moving ahead, as you would be thinking that what would be the benefits for going under Section 44 AD when I have normal tax regime. So yes, friends, let me take you through this benefits whereby you will be able to understand the government's intention, which I stated right now, and you will be able to link this. First benefit, in presumptive taxation, your net income is considered directly as 8%. Don't worry about it. The income tax is saying that we will see only your receipts. We are not going for your expenditure, whatever and however, and what quantum it may be. We don't bother about it. We only see your receipts, directly multiply by 8 or 6 as the case may be, and offer that to income, pay tax, you are relieved. But what you are relieved? This is relieved from the point of tax, but what other benefits? So yes, the main, the crucial and the important benefit, that is you don't have to maintain accounting records. So this is the best benefit, as I was talking, that from the 1 crore to 5 crore, the majority of the section or the portfolio was occupied by the small vendors, small entrepreneurs who are at the beginner stage or at the middle or lower middle category, who are hardly able to make business, and the additional burden of maintaining books of accounts as per law was becoming burdensome. So to restrict that, to curtail that, government has increased limit from 1 crore to 5 crore. In the similar fashion, 44 AD, if you are opting for it, no worry about it. You are not supposed to maintain books of accounts. On the other side, you don't have to get your accounts records audited. Why this clause was important? Because previously the limit was 1 crore. Understand, friends? And the limit for presumptive taxation was 2 crore. 1 crore, 2 crore. So there was ambiguity between opting for tax audit or presumptive taxation. So that at that point of time, it was becoming very crucial whether to go for tax audit or whether to go for presumptive scheme. Correct. So now it becomes very clear: 5 crore for tax audit, 2 crore for presumptive taxation. No books of accounts here as well. No books of accounts there as well. No audit here as well. No audit there as well. So what is the difference between that 5 crore and 2 crore? Wait. Correct. So moving ahead, you have to pay advance tax. But instead of estimating income and paying tax each quarter, you can pay all the tax, all your advance tax before 31st March. So this is again the benefit. So these are the 3 or 4 crucial important benefits opting for presumptive scheme. Don't think that presumptive and tax both are in the similar fashion. So don't need to remember this. At a later stage, when I'll be explaining, you will be under confusion that whether what is the point difference. So please keep these points in mind. This is going to be very crucial at a later stage. Moving ahead. Presumptive taxation under profession. So see this, friends, this is for business. When I'm talking about 44 AD, it is for business activity. When I'm talking about 44 ADA, jumping to next section, that is purely for the profession. So what does it state? A professional having a gross revenue up to 50 lakhs can opt for the presumptive scheme of tax, wherein he can straight away offer 50% of the gross revenue as his taxable income and pay taxes as per his slab rate. So you will find that it is like a full, it is like a jugglery. But no, let me explain you why in business it is at 8% and 6%, in profession at 50%. When you're talking about business, it involves various nature of activities. It involves trading, it involves warehousing, it involves manufacturing. A multiple level of activities are being carried out. So at the end of the day, the profit ratio is very less. Considering that 8% and 6% has been defined by the government, then why straight away 50% has been offered under service and profession? Because in the professional field, a person who is a professional has directly that is independent of the manufacturing or warehousing or any other activities. It is purely majorly there are admin expenses. Apart from that, there are no direct expenses in general cases. So the profit margin is high as far as the profession is concerned. So considering that, the straight away 50% has been provided. So if I take an example, my turnover is, say, for example, 60 lakhs, then yes, I have to offer 30 lakhs as an income, and that will be taxable. So that is what is about profession. In the similar fashion, there are benefits that, say, for example, not opting for maintaining books of accounts and audit will also be not applicable. Moving ahead, these are the other 2 points. Say, for example, in profession, as I stated, accountants, interiors, architects, etc. So there might be certain other professionals who has not been specified. So what would be the case in those scenarios? So if you are carrying out any profession, the law states that if you are carrying out any profession other than those discussed above, which I stated, you would need to maintain such books of accounts so as to enable an assessing officer, that is AO, from the income tax side to calculate your taxable income as per the income tax laws. So what does it mean? If you're not falling under 44 ADA professionals category, which has been defined, you are though in the professionals but not falling under the list, then you have to maintain books of accounts so as to ensure that the income which has been offered by you is meeting the income in the income tax returns. However, this mandate would arise only when, see, this is an additional condition which becomes very crucial at the time of practical implication. So this mandate would arise only when the income, if you are an individual, exceeds rupees 2.5 lakhs. So why I'm stating 2.5 lakhs, that is basic exemption limit, or gross receipts are more than 50 lakh in one of the immediately 3 preceding years. Correct? So that is the important criteria to be taken care. Now, you would be thinking that how to see the tax benefit or availability of the benefit to the assessee by either opting for presumptive taxation or normal taxation. So here I have presented an example. Say, for example, Mr. X is a practicing doctor and has an annual income of 50 lakhs in the financial year 1920. The actual expenses incurred by Mr. X for running his practice amounts to rupees 5 lakh. The tax liability of Mr. X for 2019-20 would be calculated as below. I have bifurcated two options. First, the tax liability with presumptive taxation, and the second being presumptive tax liability without presumptive taxation, right? So here, if I'm going for presumptive taxation, now as I was stating that, please remember those points now that will be applicable. So income, if offered 50 lakh, then if I'm presumptive taxation, which section will be applicable? 44 ADA. So what does 44 ADA say? That 50% has to be offered to income. So I will deduct expense as 50% as 25 lakh and taxable income would be 25 lakhs directly. Now, say for example, tax liability without presumptive taxation. Say for example, the income is 50 lakh rupees and the expenses, actual expenses which the doctor has incurred. As I was stating that in the profession, the expenditure are not there high apart from the admin expenses. So there were around 5 lakh. So the proceeds of the doctor was 45 lakhs. See friends, now if you can see the difference between the income that is being offered to the taxation, under presumptive taxation it is 25 lakh, whereas on the normal income it is 45 lakhs. So here it is advisable to opt for presumptive taxation, not only considering the benefit of not maintaining books of accounts or not getting books of accounts audited, but yes, you are getting a lump sum and huge benefit of tax by going into presumptive taxation. So at the time when you are coming across the amount ranging between this, so you have to keep in mind that 5 crore, 2 crore, 50 lakh, all these limits at the time to evaluate that what additional benefit you will be in a position to provide to your client, so that, because see, understand, at the day end, what are we charging for filing the return, or say for example even audits? Looking at the nature of the profession by the expanding the wings, we can see that there are numerous professionals and multiple professionals working around us, due to which there is a heavy impact on the competition in our profession as well, due to which the fees are deteriorating day by day. But on the second side, if you see the risk, the assurance function, the liability function is increasing multifold, friends. So my urge to all of you, right now I'm stating that because that came to my mind and I just want to share it all with you. My urge and request to all of you is, don't go for competition at the time of charging fees to clients. It is very important that you charge the fees on the basis of the time that you are going to devote for that assignment. That is very crucial and that is very important, friends. As you all know, in the foreign culture, people are charging on the basis of time. Where we are heading, see, we India being has recognized now a global presence, but we are lacking behind in many areas. One of them, this is the very lucrative area where we have to work upon together, because charging fees is very important, very crucial. Due to competition, we cannot reduce price and keep watching to see that one fine day cup should be there in our hand for non-compliance of any section. So my urge is, you have to assess the charging of fees on the basis of the time that you are going to devolve. The responsibility and the liability is, and the onus for that assignment is there on you. Be very practical, be very smart. So now, what benefit that customer will see? Say, for example, for filing return, you are charging 2,500 to 3,000 rupees. So that will see to the client as a burdensome. But now, see, for example, if you would have gone to normal accountant or a normal practitioner of filing return, he would have simplified the return, simplified the return by way of 45 lakh in under normal computation. But you, being a smart chartered accountant who have gone through the entire provisions of the Income Tax Act, you are in a position to identify the best benefit available to the assessee or your client. So when you are showing in this table, you necessarily show this table to the assessee that, see, normally it would have gone under 45 lakhs, but I have gone through the act and it allows that your income may be offered at a lower rate, due to which I am saving your income by way of 20 lakh, on which this much is the amount of tax which is being saved. So at that point of time, client will be happily giving you 3,000 rupees. So this is the way, or the way of presentation, how you can improve on at the end of the client. Yes, friends, moving ahead. As I was stating previously, that there are many multiple sections under presumptive taxation, out of which two we have discussed. One, that is 44 AD, that is related to business. 44 ADA, that is related to profession. There are other sections as well, as I was stating. First is section 44 AE. I am not going into detail, considering the nature and time and the importance to be given to the other important areas. So 44 AE, that is computing profits and gain of business of flying, hiring or leasing goods carriage. So there is another criteria under that nature of business. If you are going into this business, then there is presumptive taxation available. At what rate, that section will state. Similar fashion, there is another business of exploration, etc., of mineral oils. So if you are falling under that business, that will fall under 44 BB. 44 BBA states that business of operation of aircraft in case of non-residents, and 44 BBB, which is of businesses of civil construction, etc., in certain turnkey power projects. Now, why I'm not going into detail, as you all can see that all these are exceptional nature of business which do not come into regular practice. So if you come across, why discussed? Because if you come across any nature of such business, kindly refer to these sections. It will be easy for you to understand, analyze, and help the client in turn. Yes, moving ahead. The applicability, a very important and crucial part. But this is with regard to apart from the cases mentioned previously. So when I am saying, if you remember, I said that there are two conditions. One is, say for example, 5 crore is the turnover criteria under 44 AB. there was another statement that there are other conditions as well on fulfillment of which you are supposed to carry out tax audit. So I can see some questions are being raised. What we'll do is, as rightly stated by Roy sir, after the end of the session, maybe probably at the last concluding session, we'll be taking up the questions all go, because if I'm answering the questions in between, that will break the flow. Sorry for the inconvenience which is being caused right now. You can post your questions as stated by sir in the question panel, and that will be taken care by us at the end of the session, friends. Yes. So that second statement which I was stating, that there are other conditions apart from 5 crore turnover criteria. If those conditions are fulfilled, then tax audit will also be applicable. So now we are reaching to that. What all are those conditions? Yes. So that first comes business. Correct. So in business, when I'm talking about business, it is under 44 AD for presumptive, and normal assessee side under 44 AB. As I also stated, there are two criteria: business and profession. I'm repeating time and again, please mark it important. So in case of business, there are four criteria which I have considered. Correct. So be with me, because it is very important to understand, because lot of ambiguity. The importance of explaining you all the applicability starts from here, because a lot of ambiguity, questions, confusions, observations, queries, doubts arise in these 4 to 5 points. So let me begin with it. First point: if an assessee is carrying on business and that assessee is not opting for presumptive taxation scheme. Now, presumptive taxation scheme is under 44AD because it is business. So, what is the solution in that case? You can refer this chart as an, you can take printout of this screen and keep it on your wall, because this is normal understanding, so as to see in which category you are falling into. So, first category is carrying on normal business, not opting for presumptive. So, what is the solution on the other side? It is given if the total sales, turnover, gross receipts exceed 5 crore in the financial year. I have put an asterisk mark because those two conditions, 5%. If those got fulfilled, go for tax audit. It is simple. Second point: carrying on business eligible for presumptive taxation, that is AE, double B, triple B, as I have stated in the last slide. So in that case also tax audit would be applicable. How? So the condition is if those assessees claims profit or gains lower than the prescribed limit under that presumptive taxation scheme. Correct? You will not be able to understand directly. I'll explain you. Don't worry in the next point. The next point is with regard to 44 AD business, where it is 8% or 6% criteria. Remember? Yes. So the solution here is the assessee declares the taxable income. Taxable income. By taxable income, I mean income offered for tax below the limit prescribed under the presumptive tax scheme and has income exceeding the basic threshold limit. So there are two conditions. This has already been discussed previously. This is a summarized table. So there are two conditions. Before that, a business going into presumptive taxation. Thereafter, one is carrying on business, and if the 44 AD criteria of, say for example, is operating totally digitally, so tax rate would be percentage as per 44 AD would be 6%. So I apply turnover criteria, say for example 20 rupees, say for example 1 crore. 1 crore is the total turnover. I applied 6%, becoming 6 lakh. But that assessee wants to offer and say that it is not my actual profit of 6 lakh. I have actually earned profit of, say for example, 3.5 lakhs. So what would be in that case? I'm assuming that assessee is an individual. So the another condition that has to be checked is so that whether that the 3.5 lakh is exceeding the basic threshold limit. The basic threshold limit is 2.5 lakh. So answer is yes, it is exceeding. So now read that solution. Declares income below the limit prescribed under the presumptive tax scheme. So as per presumptive tax scheme, it was supposed to be 6 lakh, but he has offered 3.5 lakh. So am I supposed to go for tax audit? Yes. But wait, hold. The another condition is also there, that provided your 3.5 lakh exceeds basic exemption limit, that is 2.5 lakh, then only you are supposed to go for tax audit. Correct? Yes. Say for example, in this case, you will say that assessee has offered 1.5 lakh. So whether it will be go for tax audit under section 44AB? My answer would be no, because even though your first condition is satisfied, your second condition of basic threshold limit is not satisfied. So considering that point, the tax audit would not be applicable. Fourth point, an assessee carrying on the business which is declaring profit as per presumptive taxation scheme under 44AD. That is normal, correct? So if the total sales turnover gross receipts do not exceed 2 crore, then tax audit would not be applicable. This is so simple to understand. Moving ahead to second part, that is related to profession. Two conditions important. If I'm carrying on profession, as you all know, I stated that total gross receipts, if exceeds 50 lakh in the financial year, tax audit is invited for the purpose of under the section 44AB. Now, second, assessee is carrying on the profession eligible for presumptive taxation. Now, as it is profession, it is not under AD presumptive. Now it will be under ADA. So first condition is claims profit or gains lower than the prescribed limit under the presumptive taxation scheme. And the second, income exceeds the maximum amount not chargeable to tax. It is in the similar fashion as business. Easy to understand. Yes, a very important, a very crucial, and a very confusing part. Many of the assessees are coming and saying that, sir, during the year we have incurred business losses. So we suppose as per income tax, it is said that turnover is this much or profit is this much, then you are supposed to go for audit. But as it is loss, whether the tax audit would be applicable. So let's discuss four important points in that case, friends. First point is, in case of loss from carrying out a business and not opting for presumptive taxation scheme. So it is a case where an assessee opts for normal scheme, that is, he has incurred loss and he is not going for presumptive taxation. So tax audit would be applicable if the turnover criteria meets. Though he has incurred loss, but the condition will be same. So whether it is profit or loss, if your 5 crore condition as stated in 44AB is satisfied, you are supposed to go for tax audit. As simple as that. Second condition, if taxpayer's total income exceeds the basic threshold limit, that is 2.5 lakhs, say for example in case of individual, but he has incurred loss for carrying on a business, then in that what case? So in case of loss from business, when sales turnover gross receipts exceeds 5 crore, the taxpayer is subject to tax audit under 44AB. So even there, the tax audit is applicable. Now, third case is very important. The assessee is carrying on business. He has opted for presumptive taxation and has incurred loss, but the income is below the threshold limit. So anyone, as explained multiple times earlier, tax audit would not be applicable. Simple to answer. Fourth category, the person or the assessee is carrying on the business. Section 44AD, presumptive taxation is also applicable and has incurred loss, but the income is exceeding the basic threshold limit, then it is stated that if the assessee declares taxable income below the limits prescribed under the presumptive tax scheme and has income exceeding the basic threshold limit, then tax audit would be applicable and attracted. So these are very important points. Slide 1, slide 2, slide 3 defines the eligibility criteria to come under or invite or come into the house of 44AB tax audit. For ease of understanding, I have prepared a flowchart as well. So now, if you don't remember previously what I explained, I'll give you a short summary of what this flowchart is, so that it will be easy in your mind to analyze and understand whether to opt for which section. So be with me point by point. First point, whether conditions of section 44AB fulfilled. If the answer is yes, then please straight away go for tax audit. As simple as that. Now you are saying that no, sir, the conditions of 44AB are not fulfilled. Then I request that if your turnover is below 2 crore, then come into 44AD. Then what for turnover between 3 to 5? Sorry, Tata Sia, bye bye, go out. When I'm saying no and I'm going for 44AD, it is in my mind that 44AD is restricted to 2 crores. So if your assessee is having turnover of 6 crores, fulfilling the conditions of 44AB, straight away go for tax audit. come down. If the turnover is less than 5 crore, conditions are matched positively for 44AB, tax audit is not applicable. Is it straight away defined? No. Wait. Check first that the turnover is between 3 to 5, then okay, not applicable, please go out. If the turnover is between 0 to 2 crores, then yes, you can check or avail the option of presumptive taxation, that is under 44AD. Now, if you find that beneficial and to the client, go for presumptive taxation, that is optional. If you're not fulfilling those conditions, straight away come to whether the income is above taxable limit. Check. So your first checkpoint is 5 crore as per 44AB. Second checkpoint in specific cases 44AD up to 2 crore, 3 to 5, go out. If it not, then that bring back those 3 to 5 again to criteria. So the condition of 44AD in between is basically for turnover which is 1 to 2 crores. You can skip this and directly jump this no to this no, whereby I am saying that though my turnover is not exceeding 5 crore rupees, but whether my income, which is taxable limit, is, say for example, whether the income which is above the taxable limit, if yes, then tax audit is applicable. If it is not, then the tax audit is not applicable. So this flowchart is very easy to understand for individual and HUF. Let me remind you, friends, if you go through this section, 44AD is applicable only for individuals, HUFs, and partnership, not even to LLPs. So it is very important. Now, when I'm talking about other than these three entities, so straight away, this has to be removed. So going ahead, the straight away criteria is 44AB and the other side basic exemption limit. But when I'm saying in case of individual, it is 2.5 lakh or senior citizens criteria as applicable. But in case of other entities, it is straight away applicable. Now, we all are behind to understand, analyze of carrying out the tax audits. But as we all say that from July to September, it is tax audit season, right? And it has been observed, though, however systematic we are, however planning we do, but at the last 15 days of September, there is so much havoc in our office to file the return. And sometimes we have seen that at the last date, when we are going for filing of our return, the site gets crashed or it is under maintenance. So that creates a lot of trouble for the chartered accountants. Why? Because assessees are behind us or clients are behind us, that it was your responsibility to file. Apart from that, government has introduced various other criteria at digital platforms. Say, for example, going to our portal, CS portal, uploading it, on the other side, client side, accepting it. So there are various criteria to be made on the online signing and scanning the files, balance sheet, P&L on that portal, generating XML utility, digitally signing. So that is all the procedure to standardize the mechanism. But yes, as I stated earlier, well planned is half done. So managing the due dates for us being professionals, especially chartered accountants whose life revolves around various due dates and compliance is under various acts. So let me just take you through these due dates. So when we are talking about due dates, I have bifurcated into 4 parts, whereby we can see that the due date for tax audit report would be there. Due date for filing income tax return would be there. But if I talk about income tax return, there are 2 criteria. One, for all those assessors to whom tax audit is applicable, be it aside. For all those for whom tax audit is not applicable, keep them aside as well. Reason being, normal assessees would not be going for tax audit, so it is easy for them to compute the income liable for tax and go for tax filing of return. But as far as when you're talking about tax audit, that we'll be discussing at a later stage and by my co-speaker, that there are various other important criteria that is to be fulfilled while going through tax audit. So that has to be taken care, due to which an extended date is provided for filing of return of tax audit. Apart from that we are not going to cover, but it is very important as well, the transfer pricing criteria, for which the audit, the transfer pricing under 92A is applicable. So there also due date is different. So all these 4 criteria which are presented on the screen, right now you are seeing that more or less the dates are same in 3 and 1 case is different. But if I see in normal years or normal cases, all 4 dates would be different. Reason being, During the current time of COVID-19 pandemic, we have observed that various regulatory changes and statutory changes have been mandated and made so as to ease the compliances on the businessmen. Considering that point only, the due dates for the purpose of return filing, whether audit, non-audit, and transfer pricing has been kept as 30th November. But in case if you're an assessee, then your business tax audit report or an individual tax audit report has to be submitted by 31st of October of the assessment year, friends. Yes. So, general cases, it has been observed that the due date for filing of tax audit report and the due date for filing return of tax audit report is by 30th of September only. Whereas in case of normal return where tax audit is not applicable, July is the due date, and in case of transfer pricing, it is November, be it the case may be. So these are the important dates which you should take care and accordingly plan your tax audit season properly. Now, when I'm talking about tax audit, it becomes very important to understand. So, for example, when I say financial statement, what do we understand by the word financial statement? Financial statement is not only the balance sheet and statement of profit and loss. Mind well, friends. When I say financial statement is balance sheet, P&L, cash flow, notes, accounting policies. All this accumulated together becomes financial statement. And the auditor's report is also attached to those financial statements. So there you can see that FS is one part. I say FS is financial statement is one part and audit report is second part. How many of you do you actually know that there is a difference between Form 3CA, 3CB and 3CD? And which one is audit report and which one is the financial FS kind of part in the tax audit report? Now that clarity is very much important and very much required, not only on the part of professionals, but as well on the part of the clients. Because let me explain you. When we are talking about tax audit, there are basically two parts, dear participants. First is the audit report under Form 3CA or Form 3CB. There is another form as well, but I am taking right now only these two forms. And the second, the statement of particulars, that is Form 3CD. Now, if you want to remember it or map it with normal audit, then I'll help you. The Form 3CA or 3CB is your audit report. Mind well, friends. 3CA or 3CB is your audit report. And Form 3CD is a statement of particulars. As you all might be knowing that preparation of financial statement is the responsibility of the management. Though in the professional field or practically we do not often see such kind of practices, but yes, it is ultimately the responsibility of the management to get their accounts prepared and submit to the professional, that is us chartered accountants, for the purpose of audit. In the similar fashion, if you want to go for tax audit under income tax, your client has to fill this statement of particulars, that is Form 3CD, and submit to you for the purpose of review. And on that basis of review, you are going to submit your audit report under Form 3CA or Form 3CB. I hope I am making it clear to all of you. Going ahead. Now, when we say Form 3CA or Form 3CB, basically we have to understand which form would be applicable. Now, for easy understanding, I would say Form 3CA is applicable to companies and LLPs, and Form 3CB would be applicable to all other cases. This is a normal term which we use for our understanding. But wait, there is a simple interpretation which I have included here for your understanding and making your staff aware, because your staff is the only people who are conducting audit and preparing all these documents at the ground level. So clarity in their mind is very crucial as well. So Form 3CA. Form 3CA is furnished when a person is carrying on business or profession and is already mandated to get their accounts audited under any other law. So it is simple. It states that if you are an assessee and your books of accounts before coming to income tax is required to be audited by any other act, then we will issue a Form 3CA. Why? Because that accounts are already audited and you are giving an opinion on those accounts as well as the statement of particulars. So all such nature would be falling under Form 3CA, where person carrying on business, here I can take example of private limited, public limited companies or LLP fulfilling the condition of turnover. So if those cases are matched, you are supposed to get your accounts audited either under LLP Act or Companies Act 2013. So when you are having a client or an assessee whose books of accounts are already audited, ensure that you issue Form 3CA. So all other cases where income tax is the only act where their accounts is required to be audited, for that case you are supposed to issue audit report under Form 3CB. So example can be normal partnership forms, proprietorship concerns, HUF, etc. Right? I hope I made it clear. Apart from the normal understanding of LLP companies, I took you back to the actual meaning that if your accounts are required to be audited under any other law, please get it audited there, then come to us, and yes, we'll issue an audit report under Form 3CA. Now, you are an assessee, your books of accounts are not audited anywhere. It is only income tax who is asking you to get your books of accounts audited. Then yes, please come to us. We'll issue report under Form 3CB. Yes. Briefly taking you through the particulars of Form 3CA, whereby what all are the points that is to be covered under here. So this is just the brief points that is to be taken care at the time of filling your audit report. So point number 1 is stating regarding the name and address of the taxpayer along with PAN. So that becomes your assessee. Name of the auditor. So that is we may be individual or firm as the case may be. The law under which the accounts have been audited, as I stated, be it LLP, Companies Act, etc., maybe GST as well. Date of audit report. Then the period of P&L or income and expenditure in case of professionals. The date of balance sheet, because we are stating that we have relied upon or we have considered in framing our report the reports which are already issued under audit which is being conducted under so and so act, and the balance sheet as at so and so date and the P&L so and so date. Point 2, declaration of attaching Form 3CD. We have to give that 3CD form has been attached along with this audit report on the basis of which we have issued this report. Point 3, like we keep in our audit reports the observations or the qualifications or the points. So here also there is a point 3 which not mandates, is an optional tab whereby you can mention the audit observations or qualifications found in the details related to Form 3CD. So this is a very useful tab, friends. I will show you use of this tab at the end when I'll be giving the key takeaways. Please park it aside as a link which I'll connect at the end. Point 4, which is place and date of signing audit report, name, address and membership number of the auditor, stamp seal of the auditor, normal procedure. On the other side, Form 3CB, the date of balance sheet, the period for which we are conducting this audit, name and address, simple details are there. Point 2, but here there is a difference in Form 3C and 3CB. 3CB requires address where books of accounts are kept, address of any branches if you have, and in the similar fashion, audit observations, qualifications, comments, etc. Point 3B, where declaration by auditor is to be given that we have obtained all the information and explanatory which was necessary to carry out audit. Assurance that the organization maintains proper books of accounts and the balance sheet and P&L gives true and fair view. Now comes my point, as I explained previously, coming out of emotions, that when we are charging fees considering the competition, see the onus and burden and the responsibility that you are taking on your shoulder, friends. First, you are saying that we have obtained all the information and explanation necessary for the purpose of audit. It may become that client would have not informed you certain cases or would have not provided appropriate or adequate details. But income tax is taking declarations from your end that yes, we have obtained everything that was required for the purpose of law to carry out this audit. So this is a responsibility. Second, you are taking the onus that the organization has prepared all the books properly. Any problem in the books of accounts would definitely cause trouble to the assessee. But wait, you are taking a joint liability here that you also ensure that books of accounts are not audited. Some fine day income tax might come to your doorstep knocking that you gave an assurance under this certificate. Now provide us the explanations for the same. What will you reply? Just have a wild thought in your mind. And the third point, the balance sheet and profit and loss gives a true and fair view. The biggest disaster that we do entire our life in the profession. Keep giving views and about the fairness and truthfulness of the financial statements. So don't lean towards charging less fees, because charging less fees and giving less time is not going to help you anymore. Gone are the days when regulatory authorities are not those strict. Now with the emergence of NAFRA, that is national body, apart from that ICAI is also taking very strict actions. Companies Act, SEBI, various laws are governing the assessee. You don't know under which act you will be called for. Say for example, in case of INFS, where the auditors were themselves, including the article assistants, were called for questioning. Now understand, you are going to conduct audit of all these assessee. You don't know after 5 years, 7 years, 10 years, when you even don't remember the name of your client, how would you remember the actual treatment that you would have given in the financial statement? So 2 points are very crucial. One, charging appropriate fees, giving proper time and providing proper quality service. And second, which I am lending right now, is documentation. Very important, and very important point, which I'll be taking at the key takeaways at the last 15-20 minutes. Correct? So please mind well, friends, at the time when you are signing, ensure that what all onus you are taking on your shoulders. Yes. Then there is a declaration as mentioned in point 4 of attaching 3CD and audit observations, your name, place, sign, etc. Now, a very important part for which you all are attending this session, that is with regard to statement of particulars form 3CD. It's a 41 point detailed statement of particulars where each by point requires details from your end, confirmations from your end with regard to the assessee. Ensure that the details are being filled in proper clause with proper quantifications or proper required details as stated under the law. The detailed explanations for each point of form 3CD can be seen in the form. That is a nice format which is available. Utility is also available, and in the market there are software also available which will help you to get these tax audit reports easily prepared. Correct. My colleague would be covering this point, but so for the ease to avoid this, clause 44 and clause 30C has been extended further due to this time it is due to pandemic, else it was extended due to certain reasons. So now, as far as clause 44 and 30C with regard to that is JGAR, that is General Anti-Avoidance Rules, and Goods and Service Tax are extended third time till March 2021. So you're not supposed to worry about that. Correct. Important points under the form 3CD which my colleague would be taking. The high criteria clauses which are mainly with regard to ICDS, 48.3 cash payments, 269 SST SU with regard to advances, the GST details, the 34A clause which requiring TDS, the tabular format, the fixed asset details, clause 18, reporting in line-wise audit financial statement. This is very crucial. And the best thing that you'll be getting from this webinar is regarding the attachment of notes attached to 3CD that my colleague or I will be taking at the end. Now, not requiring to discuss, but just for the purpose of understanding, there is a clause as well in the tax audit that whether the books of accounts are maintained as required under the law. So that maintenance is stated under Rule 6F, whereby books of accounts which is to be maintained is stated like cash book, journal, ledger, So that all has to be kept by an assessee wherever it is applicable. You have to maintain photocopies of all the bills or receipts. You have to maintain the original bills or receipts as the case may be. If you are into medical profession, you must maintain these additional records too. So these are the specifically for medical professionals. So daily case registers, which is I'm going to explain two below. Daily case registers with details of patients, fees received, service provided, and date of receipt is important. So sorry, the medical profession below are the 2 points that is to be kept in mind. The stock details of the medicines and other consumable items on daily basis. Now, probably when you are completing your tax audit, it becomes now very important for us chartered accountants to ensure that the submission is proper, because we have taken very due care while conducting the tax audit. On the second point, it is very important to ensure that the work completed properly also reaches to the authority in a proper manner. So to ensure that, let me discuss what is the procedure for the submission of tax audit returns. So first stage is the tax auditor shall furnish tax audit reports online by using the login credentials in the capacity of chartered accountant. Say for example, I am a chartered accountant. I have my own credentials for income tax password, income tax portal. So will that work? No. You being a chartered accountant in the capacity of professional, you have to create your another login, which will be generated in a 9-digit number, whereby first 4 digits would be ARCA, that is ARCA, and remaining 6 digits would be your membership number. So that becomes a separate portal for you, whereby you have to log in into that portal. Once the tax auditor, so before reaching to that, once you are reaching to that, you then have to upload the audit report. Same should either be accepted or rejected on the side of client. Correct. Now, not seeing the PPT, if I say that what is the procedure for submission? So procedure submission is on both the sides. Understand? The first stage is not on the part of chartered accountant. The first stage is on the part of client. Because once a chartered accountant is appointed for the purpose of carrying out tax audit, the client has to log in into their portal, go to a specific tab where it has been mentioned to add CA. They have to add the appointed chartered accountant as an CA for carrying out the tax audit. So once it is added, it is an approved chartered accountant under that assessee. Once that exercise is done, the audit is being conducted on the other side. Chartered accountant has completed the audit, got the account signed, etc. All the procedures are completed. Once that procedure is completed, that thing has to be uploaded on the portal, on the My Chartered Accountants portal. Correct. So once that uploading is being done, that uploading will go from your portal and reach to client's portal. So in client's portal, you have to log in again and accept that yes, the reports uploaded by the chartered accountants are proper. If client finds any ambiguity or any doubt or confusion, they may reject as well. So there goes an option for chartered accountant to again upload. Is it that simple? No. For that rejection, client have to mention a note that this point was wrong or this was some problem, due to which I am rejecting the uploaded file. So then again, you can upload the file. Now, as I stated, India is a is a land of law, and as we all know, for any law to be applied in a practical manner and in a structured manner, it is very necessary that some penalty or non-compliances consequences has to be added, so that with the fear of such, the compliances are made in a timely manner. Correct. So similarly goes with the tax audit. If there has been defined a penalty for non-filing or delay in filing of tax audit report, so it states that if any taxpayer who is required to get the required to get the tax audit done but fails to do so, the least of the following may be levied as a penalty. So what does it state? 0.5% of the total sales, turnover or gross receipt, or 1.5 lakh. So maximum penalty is 1.5 lakh. Minimum penalty is 0.5% of the turnover or 1.5 lakh, whichever is lower. So now it is a burdensome procedure on the not only on the assessee, on the chartered accountants as well. The reason being, we are under the pressure to complete the audit, else client would one fine day send a debit note stating that you have filed our tax audit delayed. Now kindly pay on our behalf. Please ensure that that is being taken care properly. Yes. So about the first session, that's all from my side.
Already discussed up to clause 7. Only clause 8 that was remaining for us to discuss was regarding the tax laws that triggers the tax audit. Now, what does that mean? Clause 8 says what are the conditions here, what are the clauses which will render the assessee, which will make the assessee to follow tax audit. Clause 8, clause A of clause 8 talks about that if the turnover or gross receipts of the business exceeds 1 crore, then tax audit will be applicable. Yes, hello. If gross receipts are exceeding 50 lakhs, and if profits under section 44AE, 44BB and 44BBB are claimed to be lower than the presumptive profits and gains, then it will trigger the tax audit. Same way, if profits under section 44ADA are claimed lower than the presumptive taxation rate, then it shall be charged to tax audit. And if section 44AD subsection 4 is applicable to the assessee and the income exceeds the maximum amount which is not chargeable to income tax, that is the basic exemption limit, then it will be the case of tax audit. I'll not discuss this in much detail as Vedant has already covered. Now, coming to clause 9, what does clause 9 speaks? Here, what is clause 9 all about? It is applicable when the assessee is a firm or association of persons. Then we need to report under this clause. What do we need to report? We need to indicate the names of partners or the members of the AOP or the partners of the firm and their profit sharing ratio. Profit sharing ratio also includes the loss ratio. Means there might be case sometimes that profit sharing ratio is different and loss sharing must be different. In that case, both such sharing ratios needs to be mentioned under this clause. Now, when we talk about association of persons, as we all know, association of persons may be an association of individual, firm, company, HUF or any such other mix. And when, for example, HUF is a member of AOP and the Karta of HUF is representing the HUF, then the name of the beneficial partner or the member should be mentioned in this particular clause. Now, this clause A talks about simply mentioning the names. But when there is a change in the partners or members in the profit sharing ratio, then it is required for a tax auditor to mention such change in the member's name or partner's name. While mentioning such names, whether there is a change or not, it is always advisable to verify the documents such as partnership deed or LLP agreement or copy of forms to ensure that all the details which are reported under clause 9, which are disclosed under clause 9, are truly disclosed. Secondly, we also need to, as a tax auditor, friends, we also need to check the acknowledgement of the copy which is filed with the registrar of firms in case the partnership firm is registered and the deed is filed with the registrar. One question arises when there is a minor in the partnership firm. What do we, minor can be admitted for the benefits in the partnership firm. Okay, so the profit sharing ratio with that such minor should also be disclosed. Obviously, loss sharing will not be there, but profit sharing should be disclosed. But when there is a case of dissolution of firm, this clause is not applicable as the firm will cease to exist. Now, the question comes, when there is a change in profit sharing ratio, do we need to disclose? Yes, as we discussed, when there is a change in name or other details are to be mentioned. Same way, profit sharing changes are to be also mentioned. The question comes whether the remuneration given to partners or interest given to partners are to be disclosed under this clause or not. This is a very subjective matter, and any such change in remuneration or interest does not need to be disclosed generally, but in one of the landmark judgment of CIT versus RM Chidambaram Pillai The apex court has held that salary given to partner is not a charge of profit, but it is appropriation of profit. And any appropriation of profit directly or indirectly renders the change in profit sharing. Accordingly, change in salary during the year should be construed as change in PSR, and thus it should be indicated in this clause. Coming to next clause, that is clause 10. Clause 10 talks about nature of business and profession, which the assessee carries out. Now, there may be a case where the assessee is involved into two or more kind of more nature of businesses or professions. So, the tax auditor is required to mention all the activities carried out by the assessee. Now, how to ensure? From where do we ensure that the assessee is into this kind of businesses only? So, we need to be very sure that the financial statements when we disclose the significant notes to balance sheet and P&L, therein generally the object is mentioned, the what the company is into is mentioned, and the best way to find out this is to verify the incorporation documents such as memorandum of association in case of company, or partnership deed in case of a partnership firm, LLP agreement in case of a LLP, or any such other relevant document. Again, we should always remember that tax audit report is more of disclosure nature. So if there is any change in the particulars, may it be name, address, partner's name, or the business or profession nature, there is any change, the tax auditor has to report such change. Now, change can be due to different reasons. First reason could be that maybe new business has been started, or permanently some business has been discontinued. Then such change coming out of this restructuring should also be disclosed. Second thing, when there is a reconstruction or reorganization in any organization, then it is very important to confirm that such things are approved. In the case of company, the minutes of the board meeting may be verified upon, may be referred to check whether such change in the business is approved or not. And again, it is very recommended for every tax auditor to obtain the declaration, obtain the representation from the assessee with respect to such change. Now, there is a very important point for present scenario, that is when we are suffering from pandemic. Many of the businesses have been hampered. Many of the business organizations, may it be sole proprietor, partnership, company, or any such organization's business have been hampered. Now, when there is a permanent discontinuance of any business, this change has to be mentioned. But what about the temporary suspension? When there is a temporary suspension of the business, may not be construed as the change in the business. So maybe from the month of March to July, some business houses must have not carried out any such business. In that case, the reporting under this clause is not so warranted. Now, since we have understood what is to be disclosed in business and profession, it is important to know the requirement of books of accounts. Why? Because any entity carrying out business or profession must maintain a books of accounts relevant for the record maintenance and tax audit or statutory audit as applicable. So, clause 11 talks about the books of accounts. The tax auditor needs to ensure that whether books of accounts are prescribed under section 44A and such books of accounts are maintained by the assessee or not. If such books are not maintained, if any deviation is found, reporting is required. Second thing, only maintaining books of accounts is not important, but how the books of accounts are maintained, where are they maintained? I mean, at registered office, or where is the place where such all records are combined and maintained, that is also to be kept ready for ready reference. Second thing, for For particularly this tax audit, every person whose turnover limit is crossed according to a specified limit needs to compulsory maintain certain books of accounts, and that certain books of accounts are very basic: cash book or journal or ledger. And suppose if when we talk about the professionals, every profession demands different kind of books. As in, when we talk about doctor, he must maintain a daily case register. When we talk about architecture, he must maintain receipts from the architectural projects which he may be carrying out, and so on. When we talk about a CA firm, then we need to maintain books of accounts that should show that revenue or professional fees charged from the clients for carrying out different types of assignments. And such a way, our books should be maintained, which should be very much relevant and readily available for tax audit if applicable. Clause 12. Clause 12 talks about profits and gains on presumptive basis. Now, there may be a case that the assessee is carrying out some business which is normal business and other business which might be taxed on presumptive basis. Now, there can be three scenarios. The first scenario is that books of accounts are not separately maintained for both the businesses. In that case, the tax auditor may arrive at a fair and reasonable estimate of the expenditure based on the evidence and information in possession by the assessee, and the auditor may also ask for the estimation or the appropriation on relying on which the assessee has bifurcated the expenses of normal business and presumptive business. The second scenario could be books of accounts are separately maintained. So we are good to go when there are separate books of accounts maintained, then there is no problem and there is no loophole, and it is very easy for the tax auditor to determine or to ascertain the amount of profit to be disclosed for presumptive basis. Third part is business under presumptive scheme is additional business. No separate books are maintained for the same. Now, what is the difference between first and third one? First was like the assessee was actually into two businesses and he used to maintain books of accounts for both the businesses together. Here in the third one, it is like assessee is not maintaining for presumptive business at all. So in that case, the tax auditor will be unable to find out the correctness of the profit or correctness of the income credited to the profit and loss account of the assessee in respect of the presumptive business, and therefore auditor is required to disclose it via suitable note expressing that he was unable to verify the said figure. Clause 13 talks about the method of accounting. Now, method of accounting, to think about, then this is very simple clause because it talks about either accrual basis or cash basis. But now, after the introduction of ICDS, this clause is very important and very essential to understand. This clause is divided into 6 sub-clauses. First part is we have to just disclose the method of accounting employed in the previous year. May it be mercantile basis, that is accrual, or may it be cash basis. Second sub-clause B is whether there had been any change in the method of accounting employed vis-a-vis the method employed in the immediate preceding previous year. This is nothing but accounting method deployed this year versus previous year. And if there is a change in such accounting method, then reporting under sub-clause C is required, and we have to quantify the details of such change and the effect thereof on profit and loss account of the entity. Now, DEF talks about the ICDS. Now, whether any adjustment is required to be made to the profits or loss for complying with the provisions of ICDS, as all the entities or organizations, companies or partnership firms may be following Ind AS or accounting standards, as the case may be, they must be following some policies, some accounting policies for different components of their balance sheet and P&L. In those cases, it is very much required for a tax auditor to ensure that when there are any deviation from the policy followed in accounts vis-a-vis policy mentioned in ICDS, then the disclosure for deviation is required. And when there is an affirmative answer to subclause D, then the quantification or the effect is to be provided in clause E. Clause F talks about the disclosure as per ICDS कि हमको क्या what disclosures are required ICDS wise. What are 10 ICDS that we will discuss in subsequent slides. All the companies are mandatorily required to follow mercantile business basis of accounting. As we discussed, there can be two types of accounting, cash or mercantile. There is no hybrid type of accounting. So there should not be any case where the clients are following hybrid. Either we should follow cash or we should follow mercantile. Wherein if the client is a corporate entity, that the companies, then it is mandatorily required to follow the mercantile basis of accounting. And in other assessees, that is non-corporate assessees like partnership firms or sole proprietorship, trust, individuals, HUF, etc., they can follow cash or mercantile basis unless there is some statute which governs that the enterprise is required to follow a particular method of accounting. Now, what are those 10 ICDS? They are very much similar to accounting standards, but the provisions or disclosure requirements may be different in each of the ICDS. ICDS 1 talks about the accounting policies, which is to be regarded as against the accounting standard 1, that is the disclosure of changes in accounting policies. ICDS 2 is valuation of inventories, which has to be compared against AS2 valuation of inventories. ICDS 3 construction contracts vis-a-vis AS7 for construction contracts, the policies followed by the company to recognize the revenue under the construction contract. Then ICDS 4 revenue recognition for as against the AS9. ICDS 5 in tangible fixed assets has to be seen according to the policies followed by the companies as per AS10. ICDS 6 changes in foreign exchange rates has to be curbed with AS11 effects of changes in foreign exchange rates. ICDS 7 government grants has to be seen with AS12 government grants. ICDS 8 securities, that is financial instruments and other securities. Then ICDS 9 borrowing cost has to be seen with AS16, and ICDS 10 provisions, contingent liabilities and contingent assets, which has to be seen with AS29. Now, when there is a, you can say, tug of war between accounting policy versus ICDS, then we have to report what are the different provisions as mentioned in ICDS and what different we have followed in preparation of our financial statements according to our applicable accounting standards, and such report on effect of profit due to deviation from each ICDS has to be mentioned separately. And for disclosure requirement under this clause, one need to take base of the significant accounting policies. Means, suppose if we have followed method X in accounting policy and method Y is described in ICDS, then the journey from X to Y and the impact thereon because of the said impact on profit, that has to be disclosed. Clause 14. Clause 14 talks about the valuation of closing stock. Now, as per accounting standards, that is AS2 or Ind AS 2, method of valuation of closing stock has to be employed by the assessee in the previous year, which should be cost or NRV, whichever is lower. But in case any deviation is there as per the method of valuation prescribed under 145A, then such effect has to be given. Now, what is 145A? There are deemed the two models, that is exclusive model or inclusive model. Accounting standards generally prescribe exclusive, that is we have to exclude the different indirect taxes or such as excise duty, VAT, etc. incurred while procuring the inventory, and such amount should not be included in the cost of inventory while recording the same through accounting standards. But when we see as per 145A, it talks about inclusive method. That is, the adjustment regarding excess duty, VAT, etc. has to be considered in the cost of the inventory while procuring the inventory. And in such a case, we need to give the impact of the same on the profit of the entity. But when there is a case of conversion of capital asset to stock in trade, then and if that stock in trade is valued at FMV, the same should also be stated here. Clause 15. Clause 15 talks about capital asset converted into stock in trade. Now, when it is decided that the capital asset has to be converted into stock in trade, it will be considered as transfer under capital gains, and it should be offered to tax under capital gains upon conversion of such capital asset into stock in trade. Now, what is such a transfer has to be regarded as taxable? It should be regarded as taxable in the previous year in which such conversion takes place. Description of capital asset. Suppose the company was into business of manufacturing or procuring cement, and then the company started trading in real estate also. Then the land and building held as investment with the company may become stock in trade for the company. So the earlier such land and building was capital asset for the company, but now such asset has become stock in trade for the company. Then such detail of capital asset has to be provided in this clause along with the section 32 requirements. That is, section 32 talks about the depreciation, and if such capital asset is a depreciable asset, the details thereon should be provided. What should be the date of acquisition? The auditor needs to confirm the date of acquisition as to ascertain the period of holding of asset, because whether such asset will be long-term capital asset or short-term capital asset is important to derive for offering the said income from capital gains to tax. Second, cost of acquisition. Cost of acquisition of capital asset shall be regarded as per the relevant accounting standards, and it should be cross-verified with purchase invoice or cash in bank account or fixed asset register, etc. Amount at which it should be converted to stock in trade should be as per AS2, and in case, as we already discussed, that if such conversion is done at FMV and not cost, then such appropriate disclosure is to be made in the clause 14, and the note should be given in the notes to 3CD. Clause 16 talks about amounts not credited to the PNL. Now, what can be amounts not credited to PNL? There can be many income which shall not be regarded as business income, but and that is why they are not credited to profit and loss account. For example, escalation claims or the pro forma credits or duty drawbacks or refund of duty from customs or excise or any other indirect tax or refund of sales tax, where such amount is considered as inflow for the entity, but it is not regarded as income of the entity and is not credited to the profit and loss account. Now, this clause is intended just to report those incomes which are not so ordinary in nature, and that is why it will not be regarded as business income. But it is important to disclose the same to the tax authorities. When export benefits are availed by the assessee, it should be covered under this clause, even if they are not considered in P&L account of the entity. When a capital receipt is earned by the entity or something, that is when it is easier to know from cash flow statements, that is cash flow from investing activities or cash flow from financial activities. The receipts which are not revenue in nature, receipts not operating in nature, would be considered as capital receipt, and generally it will not attract the tax. But if the transaction is specifically covered under such provisions, then such a receipt should be reported here. Now, transfer of land and building under section 50C or 43CA. What does that talk about? Immovable property held as capital asset or immovable property held as stock in trade. Now, reporting is required in both such cases. First, we will discuss immovable property held as capital asset. If the sale consideration of the immovable property is less than the stamp duty value. Now, when the entity is transferring land or building or any immovable property as a capital asset, and the consideration received by the entity is lower than the stamp duty value assessed in respect of such property, then the difference has to be reported. Same way, if such immovable property is transferred as stock in trade and the fair market value, which is regarded as income for the entity, then it should be, again the difference has to be reported here. Clause 18 talks about depreciation. Depreciation, for disclosing the details regarding depreciation, the tax auditor needs to ensure that various relevant details are mentioned, such as, first of all, we need to mention description of asset or block of asset. The tax auditor needs to identify the block of the assets in which the assets of the entity falls and the relevant rate of depreciation applicable to such block as per the income tax rules must be taken care of. While identifying the block, it is important to know whether the block is newly generated in the previous year or it is carried forward, carried down from the previous year. If the actual cost is there, then it should be ensured that actual cost is determined as per the AS 10 or Ind AS 16 as applicable. And when there is the old block only, and in case the auditor needs to verify the written down value of the block, then it is advisable to ensure the same from the income tax return that the opening WDV of block of assets is same as closing WDV of the previous year. When there is an addition or deduction from block of assets, now there can be a case that the assets are being purchased or sold by the entity during the previous year. Then the auditor needs to obtain the list of such purchase and sale of assets and get it certified from the management. Now, when there is a purchase of asset, there can be a case that the management has purchased the assets using the borrowings, or the specific borrowings has been applied for acquiring such assets. In that case, the borrowing cost must be capitalized as per the by considering AS 16 as well as ICDS 9. Other adjustment. Now, there can be a case when the entity has acquired capital asset and maybe some subsidy or government grant has been received by the entity, or there can be the case where there can be foreign exchange gain or loss, that is foreign exchange fluctuation may be applicable when the machine is being imported or some other assets are being imported. In that case, such adjustments are also to be given effect to while disclosing the details in clause 18. Clause 19, amount admissible under sections as mentioned below. Now, what does this say? Because the entity may carry out some research function or development function, or some investment is done, and such amount is claimed as exemption or deduction by the entity. So in these cases where special deductions are allowed for prescribed business or for prescribed activity, then the tax auditor is required to check whether the assessee has complied with all the necessary conditions, because suppose when any expense is done for research and development in the field of science and technology, then the income tax department, or then it may be required that the assessee is required to furnish DSIR certificate. DSIR is nothing but development in science and information research, and in this case the chartered accountant has to certify those expenses for which the entity is claiming exemption under specified section. Clause 20. Clause 20 talks about bonus, commission and contributions to welfare dues. What does this really is? Because when we talk about the employee benefit that is given in the form of bonus or commissions, the tax auditor needs to ensure that the amount given over and above the salary of the employee as a part of bonus or commission, it should be in the terms of employment that can be verified from join appointment letter or their contract letter, but and it should be very much ensured that it is not the indirect distribution of dividend or profits, because to curb DDT, the entity may give amount of dividend in the form of bonus or commission and claim deduction for that. So in that case, if dividend is given sugar coated with the name of bonus or commission just to avoid the dividend distribution tax, then such expense will be disallowed by the tax authorities. Second thing, if we talk about employee benefit contributions such as to PF or ESIC or any superannuation fund, if the employer has collected contributions to such funds from the employees and such amount is not deposited with the relevant authorities within the due dates specified in those relevant acts such as PF Act or ESIC Act, then the amount shall be disallowed to the assessee on account of the employees when such amount is failed to be deposited with the relevant statutory fund on or before the due date. Clause 21 talks about amount debited to profit and loss account. Now, amount may be debited for business expense, for personal nature, or maybe for capital nature, advertisement. Such amounts, when they are debited in the profit and loss account of the assessee, then tax auditor needs to check whether such amount will be fully disallowed or partly disallowed and partly allowed subject to such certain conditions. Example, director's membership fee of club has been paid by the company. So that is the director's personal expense and that shall not be allowed to the expense of that shall not be allowed as an expense in the P&L account of the company. In that case, such kind of expenses has to be disallowed, and any other advertisement expenses for which the company is not deriving any benefit, such amount shall be disallowed. Now, amounts inadmissible under section 40. Now, when there is a requirement to deduct any tax as per TDS provisions, and if the assessee has failed to deduct the tax, then such amount may be partly or fully disallowed as the case may be if there is a failure on the part of the assessee for deduction of tax. Second, when the amounts are debited to P&L, being interest, salary or bonus or commission, inadmissible under section 40B or BA and the computation thereof. What does this mean? That when there is a payment towards interest or salary towards a partner or a partner of LLP or a partnership firm or the members of the AOP, and if such amount is not admissible under this particular section 40B or 40BA, then that shall be disallowed and the amount such amount has to be disclosed in this clause. Clause D talks about disallowance or deemed income under section 40A3. What is 40A3? Because if the assessee has done expenditure up to certain limit, that is 10,000 in cash, then that is okay. Otherwise, when there is any expenditure incurred by the assessee in cash in amount exceeding 10,000, then the same shall be disallowed. But there are again certain conditions which needs to be taken care of, such as if the amount is paid for plying, hiring or leasing of goods carriages, then the limit shall be different. The tax auditor needs to refer Rule 6DD of the income tax rules and while seeing this clause. In continuation to such clause E talks about gratuity provision made by the assessee. Now, for all the employee benefit expenses, we come across that the entity has made gratuity provision. So if there is any outflow as a payment to retiring employees or leaving employees during that particular year, then such payment out of that provision of gratuity shall be allowed in income tax. And otherwise, if there is no outflow on the part of entity, then such provision shall be disallowed, and it will be actually allowed when the such amount is actually paid to the employee for which this provision is created. Any sum paid by the assessee as an employer not allowable under section 40A9. What does this talk about? 40A9 talks about that any contribution made to any fund or trust or company, AOP, BOI, societies or other institution for the purpose for the purpose of this any payment incurred by an employer towards the setting up of any fund or trust, then such amount will not be allowed as a deductions. That is, if the employer is paying, suppose the assessee is a company and the company is creating its own trust or own funds, and any amount paid towards the setting up of such fund, then that should not be allowed as expense. Clause G talks about particulars of any liability of a contingent nature. Obviously, as we talk, we need to consider ICDS 10 and AS 9, that if such a liability usually relates to ongoing legal disputes where it is not certain that there will be a liability for the assessee, then obviously then such amount shall not be allowed as expense. Rather than it should be shown as contingent liability in the financial statements. Basically, tax auditor needs to be mindful of the distinction between the contingent liability and the provision. And this can be done by scrutinizing the accounts relating to the provisions and outstanding liabilities to ensure that they do not contain any provision for contingent liabilities. That is very much important to ensure. Second thing is amount inadmissible in terms of section 14A in respect of the expenditure incurred in relation to the income which does not form part of the total income. Means there must be some exempt income, such maybe SEZ income or any other such exempt income, and if any expenses are incurred to earn that income, then that shall be disallowed. Very simple. Why? Because if any income I am earning that is exempt, the expenses done for that regard should also not be allowed. Otherwise, it will be like double exemption for the entity or for the assessee. 21I. It talks about amount inadmissible under the proviso to section 36(1)(3). 36(1)(3) talks about the interest on loan, and in line with ICDS 9, that is borrowing cost, where interest is paid in respect of amount borrowed for the purpose of business is not allowed till the asset is put to use. As we all know, the borrowing cost AS 16 or ICDS 9 says that if the asset is not put to use, then interest incurred from the date of loan to the date of put to use of the asset shall not be allowed to the assessee. Clause 22 talks about interest inadmissible under section 23 of MSMED Act. Now, what is that interest? With an introduction of MSMED Act 2006, the government has introduced the interest provision for MSMED. That is, if the company is dealing with MSMED creditors and the company has not made payment to such creditors within 45 days time or lesser time as agreed in the invoice, then the entity is required to pay interest as per section 16 of MSMED Act 2006, and in such a case, the interest so paid on that unpaid amount has to be disclosed here, and such amount shall not be allowed to the assessee in preparation of computation of income for the purpose of income tax. Now, how the tax auditor can confirm this? the tax auditor needs to obtain the list of MSMED creditors the company is dealing with and aging of such amount payable to such suppliers to determine whether any interest is payable or not, and if any such interest is payable, the same should not be allowed as expense in computation of income under Income Tax Act. And if there may be a case that relevant information is not ascertainable from the records of the entity, and so amount due or interest payable is not ascertainable, such fact should be brought upon by the tax auditor through the notes to 3CD. Clause 23 talks about payments made to persons specified under section 40A to B. 40A to B talks about payments made to relatives. That relatives as per Income Tax Act of the SAC. If there is an individual, the relative definition will be different. For companies, relative definition will be different. And these all are called related parties. The tax auditor needs to review the list of transactions with the related party as per the related party note disclosed in the financial statements, and should ensure that all the parties covered under AS 18 are not identical. Means if there are if we are doing tax audit of a partnership firm, then the partners or the relative of the partners may be the related party of the concern. And if there is a company, then the directors or the case may be the related party of the company in that or subsidiaries or in that case. So if any salaries and perquisites are paid to directors or person having substantial interest in the company should be included in the list referred to as we discussed in related party list. All such disclosures are to be made. And one important point here to note is the auditor is responsible only to report the transactions with related parties and not to comment upon the reasonableness of related parties transaction or the amount whether the same has been considered as per arm's length or not. Such the fair market value of the transaction done with the related parties are not to be commented. Rather, only disclosure that such transactions are carried out with related parties by the SSC has to be disclosed in this. And there may be case when we are auditing a very big company or a very big firm where there are very voluminous related party transactions. That is, suppose sale is made to 100 related parties. In that case, the auditor may group all the sale transactions and may report like this: various related parties, sale of goods and services, and the amount is reported in a consolidated manner. That is up to the tax auditor and his professional judgment. How does he want to report it? Clause 24. It talks about the deemed profits and gains under section 32 AC, AD, AB, 33 AB, 33 ABA, or 33 AC. Now, what all these 5 sections talk about? 32 AC will not be relevant now since AY to 2018 to 2019, so it will not be relevant now. But 32 AD, that is investment in new plant or machinery in notified backward areas. 33 AB is tea development account or coffee development account and rubber development account. 33 ABA for site restoration fund. 33 AC for reserves for shipping business. In such a case, if the assessee has availed any deduction while doing site restoration fund business or the reserves for shipping business, and subsequently there are violation in any of the conditions and such deduction claimed are not holding good in the present case, then such deduction shall be reversed and will be considered as deemed profit and gain for the assessee in the year in which violation of conditions specified under these respective sections takes place. Clause 25. Clause 25 talks about the profit chargeable to tax under section 41. Under section 41 talks about different scenarios wherein deduction must be taken by the entity earlier. Now the income has been received against such deduction, or as the case may be, and then considering the receipt of income or inflow to the entity, this shall be taxed under section 41 and shall be reported under clause 25 of form 3CD. Now, there can be a case that the deduction has been allowed by the income tax authority in the earlier year, and the assessee has received some benefit in the present year, in the current year. Then such benefit shall be charged to tax. But another classic example is the entity must have charged the amount as bad debts, and 2 years later the entity has recovered that amount. Then such bad debts recovered shall be charged to tax under section 41. There may be a case when the entity has acquired some asset for the purpose of scientific research, and the entity has claimed the amount of asset entirely under section 35 as a deduction for carrying out research work for scientific research and development, and then the entity sells such asset. So the consideration flown to the entity for such sale of asset shall be regarded as profit under section 41. Secondly, if again the entity was engaged in power generation or distribution and the exemption has been claimed by the assessee, and now the asset is sold by an assessee for a consideration, then such consideration till the extent it exceeds the written down value of the asset shall be charged to income. When the entity has withdrawn the amount from some special reserve, for which the deduction has been claimed on creation of such special reserve, then the same shall be charged to income tax. These are few examples wherein income shall be charged as per 41 and disclosure shall be given in clause 25. Clause 26. Clause 26 talks about the sum referred to in section 43B. 43B is nothing but avail deduction on payment basis. For the expenditure such as cess, taxes, duties, or interest to bank, the law says that if the assessee has made payment towards such expenses, then and then only it shall be eligible to claim deduction on that regard. That is, deduction shall not be available on accrual basis, at least for these kind of expenses. Now, there can be two scenarios. Reporting may be required for pre-existing liability, and if that liability is incurred during the year. For example, the loan has been taken by the entity in the previous year, but no interest has been paid. So amount of such interest was disallowed during the previous year. Now, by the start of the current year, the amount was pre-existing on the first day of the year, and such amount was disallowed during the previous year. And if such amount is paid during the current year, and even if it is not paid during the current year, the reporting is required under clause 26. Now, there can be a case the loan is loan is availed by the entity in the current year, and amount of interest is not paid till the last date of the financial year, but it is paid on or before the due date of filing return. That is due date as per section 139 subsection 1. And even if such amount is not paid, then also reporting is required. Coming to clause 27. Clause 27 talks about amounts of SENVET. Now, SENVET may be for SENVET credit or the prior period items. There can be case the entity has availed SENVET or utilized the SENVET during the previous year, and its treatment is given in P&L account. And the treatment of outstanding, that is for unavailed SENVET credits in the accounts. This is nothing but a disclosure clause. The auditor needs to obtain the details from the assessee regarding the SENVET credit availed during the year, not availed, balance left with the accounts with the assessee. All such details have to be disclosed in clause 27. There can be a case where particulars of income or expenditure of prior period credited or debited in the current year's profit and loss account. Now, when we see a AS5, that is AS5 talks about disclosure and identification and disclosure of prior period item, and it should be properly disclosed in financial statements. So the tax auditor also needs to obtain the list of prior period items from the assessee, and relevant disclosure must be made in clause 27. Clause 28. When the assessee has received any property. Now, what is that property? Property are the shares of any company. Shares of the company, and such company is not the company where the public is substantially interested. So, breaking the reading between the commas, that the assessee has received any property, that property is a share of a company, and without any consideration or for inadequate consideration, then such details have to be furnished. In that case, if the fair market value of such shares minus the amount paid, if any, that is inadequate, exceeds 50,000, such excess income shall be taxed under income tax, shall be taxed under the head income from other sources. Now, whether or not it crosses 50,000 or not, reporting is to be made. Disclosure has to be done. But whether it will be taxable or not, that for that limit of 50,000 has to be checked. Clause 29. Clause 29 is similar, that whether during the previous year the assessee has received any consideration for issue of shares. In clause 28, we discussed the assessee has received shares for inadequate or without consideration. Now here the assessee has received consideration for issue of shares, and that consideration exceeds the fair market value of the shares as referred to in section 56. Now, there may be a case that the company has issued shares on premium. The fair market value of the share of the company is 100 rupees, and company has issued share on at 120 rupees. So, in that case, if the income provisions of this clause will be applicable when shares are issued at premium, and valuation is done as per Rule 11U UA of the Income Tax Act. And it is very much important for an auditor to verify that the valuation of share is done in case of unlisted company at least. But there are few things which are not to be reported under this clause. That is, shares issued to non-residents, share issued by company in which public are substantially interested, shares issued by venture capital undertaking from venture capital company, or share issued at face value. Because as we already discussed, disclosure is required only when shares are issued at premium or shares issued at or below fair market value should also not be reported. Clause 29A. Whether any amount is to be included as income chargeable under the head income from other source as referred to in 56 subsection 2 clause 9. What does this talk about? That if the assessee has received any advance in the for transfer of capital asset, let's say the assessee has made a transfer deed for sale of machinery, and it has received any advance. Now, for after few negotiations or after lapse of time, the transfer deed got cancelled and the advance has been forfeited by the assessee. Then such disclosure of forfeited advance needs to be reported under clause 29A, and such advance forfeited will be taxed under income from other sources in the income tax return. Clause 29B. Whether any amount is to be included as income from other sources as per section 56 subsection 2 clause 10, this is pretty simple. We have to check three conditions: whether the assessee has received any amount exceeding rupees 50,000 with or without consideration, then he has to declare without consideration, then he needs to declare such amount as income from other source. And in case of immovable property, if without consideration the assessee has received immovable property whose stamp duty value exceeds 50,000, or if for a consideration which is less than stamp duty value by amount exceeding rupees 50,000, then such transaction detail needs to be reported under clause 29B. Same way for movable property, fair market value of which exceeds 50,000 for without consideration, and for a consideration which is less than fair market value by amount exceeding 50,000, then such value needs to be reported. Clause 30. Clause 30 has almost died its natural death, I would say, because it talks about Hundi. Hundi generally means Hundi is actually not defined under this act, but CBDT via its circular number 208 dated 15th November 1976 has explained the scope and characteristics of the said term, that is Hundi. That Hundi is nothing but a promissory note drawn in a vernacular language. So when we talk about Gujarat or something, Maharashtra, the Hundi may be in Gujarati or Marathi, and for Kerala it may be in Kerala language. If I am not wrong, please spare me if I could not say the language properly, but the local language, vernacular language. So any amount borrowed on Hundi or repayment of the same has to be made by account pay check. That is the main crux of this clause. Main
It's
crux of section
Malayalam.
D rather. Yes?
Malayalam.
Acha, Malayalam. Okay. So, so coming back, when hundis are issued and it is borrowed or repayment is done other than account pay check, then such reporting has to be done under clause 30. And if the borrowing is taxed, then repayment will not be taxed again in the year of repayment, because it will create double taxation and it will be unfair to the taxpayer. Clause 30A. Clause 30A talks about the primary adjustments. Primary adjustment that are referred to in transfer pricing as per and such details are given in Form 3CEB also as specified under Section 92CE. But this clause has been specifically added to Form 3CD with effect from 20th August 2018. Why? Because the tax audit report needs to include all the primary adjustments to the which are made by the transfer pricing officer or the assessee voluntarily, or may be determined by the advance pricing agreement, or as per the safe harbor rules, or as per the way of mutual agreement procedures, or DTAA. For any such route, if such primary adjustments have been made in the Form 3CB of the assessee, then such amount has to be disclosed in Form 30A also. What all details are need to be furnished here, that is important to know. That under which clause of subsection 1 of 92CE primary adjustment is made. Which clause? That all the clauses which I just said, that is suo moto, or by the assessing officer, or by the APA, and so on. Then amount of primary adjustments, and if the excess money available, if the excess money available is whether the excess money is available with the associated enterprise situated outside India, that is to be considered for secondary adjustment as per Section 92CE, then such amount, whether repatriated or to be repatriated to India, such amount should also be disclosed in this clause. And when such secondary adjustment is warranted, whether such excess money has been repatriated within the prescribed time or not, that is 90 days from the due date of filing ITR, that is the limit given under 92CE or rules of transfer pricing. that the tax auditor needs to confirm. And if such amount is not repatriated, then interest should be computed on such excess money and shall be offered to tax as and shall be added to income of the assessee as per transfer pricing. Clause 30B. Clause 30B talks about the limitation of interest deduction for borrowings. Now, Section 94B talks about the limitation on interest. That is when the assessee has borrowed funds from its associated enterprise, then the interest paid or payable to the associated enterprise has to be limited. Limited up to what? Limited up to 30% of the EBITDA, that is earnings before interest, taxes, depreciation and amortization. So what all disclosures are required under this clause are that amount of expenditure of interest, amount of expenditure by way of interest or the similar nature, then amount of EBITDA, then 30% of EBITDA amount which is to be allowed as interest, and details of interest expenditure brought forward. Why? Because when, for example, if the interest is rupees, interest paid by the assessee to its associated enterprise is rupees 100 and EBITDA, 30% of the EBITDA is only rupees 60, then 40 rupees interest shall be disallowed. And that 40 rupees disallowed interest will be carried forward to the next year. And then when the EBITDA is healthy, when the when the earnings of the entity is healthy, in that cases, we will be able to claim the interest excessively paid in the previous year, which was disallowed in the previous year and carried forward to the next year and shall be claimed as deduction in the current year. Now, clause 30C, impermissible avoidance agreement. What is impermissible avoidance agreement? It is important to understand this first. An impermissible avoidance agreement would be an arrangement where the main purpose is to obtain a tax benefit. Tax benefit may be by avoiding tax payment or evading the tax, or maybe eroding the base of tax directly or indirectly. Any such agreement which lacks commercial substances or is carried out in a manner that does not otherwise occur if the arrangement was done for bona fide purpose. That means anything done for not so bona fide purposes shall be regarded as impermissible avoidance agreement if such amount is if such thing amounts to tax evasion or tax avoidance. Now, it is important to note that what is required to be reported under clause 30C. Whether the assessee has entered into an impermissible avoidance agreement as referred to in section 96 during the previous year. If yes, first of all, we have to say yes or no. And if there is the answer is affirmative, then the nature of such agreement and the amount of tax benefit that has been availed by entering into such arrangement. Clause 31. The one of the most lengthy clauses of tax audit, but it is like, if we see this clause, it is lengthy, but reporting is very simple and very transparently. The tax auditor needs to report all the details required under this clause. Clause 31. Clause 31 talks about the details of loans or deposits taken or any repayment made, that is in line with 269 SS and 269 ST and 269 T. We will consider one sections at a time. When we talk about 269 SS, the particulars for each loan or deposit in an amount which exceeds the limit specified in 269 SS has that is taken or accepted by the entity by the assessee has to be reported. And what all details are need to be reported? That is name, address, PAN of the lender or the depositor. That is from the person from whom the assessee has taken such amount of loan. And the maximum amount outstanding at any time during the previous year from that particular person has to be reported. And suppose if you have taken deposit for of rupees 1 lakh from one person in the month of June and repaid in the month of October, such a transaction is squared up, but still the same amount has to be reported that such transaction took place during the year. Now, in A, we have to mention this amount and whether the same has been taken or accepted by check or bank draft. May it be from cash or something, cash में allowed नहीं है, but अगर ले भी लिया है तो disclose करना रहेगा. Second thing, when such advances are in relation to transfer of immovable property, then the similar details as we discussed in clause A has to be reported under clause B. Clause BA. Clause BA talks about the particulars of sum in an amount exceeding the limit as per ST. What is 269 ST? Limit is 2 lakhs in aggregate. Now suppose there are three conditions in first of all that we need to understand, that 2 lakhs amounts received from 2 lakhs or more in any of the following cases, that is in aggregate from a person in a day, in respect of a single transaction, or in respect of a transactions relating to one event or one occasion from a person. So the auditor needs to verify the cash book, whether such cash is received of rupees 2 lakhs or more in a single day. The auditor needs to verify all the ledgers and documents which warrant such receipt by the assessee, and where any exceptions are exceptional treatment or exceptional transactions are noticed, such amount has to be reported. All the amount received in excess of 2 lakhs has to be reported here. What is BB? Clause 31, subclause BB. It is that when the assessee has received amount from any person in excess of the limit provided under 269 ST via check, but that check or bank draft is not an account pay check or account pay bank draft, such amount has to be differently disclosed in this particular clause. Particulars of each payment. What is BC? BC talks about the payment made. BABB was regarding the receipt and BCBD are regarding the payment. Mirror provisions, but for payment. For payment made other than by check or bank draft or using ECS. And BD talks about for check or bank draft not being an account pay check or bank draft. So basically BABB for receipts, BCBD for payments. Clause 31, subclause C. Subclause C talks about the repayment of loan or deposit that has been availed by the assessee in excess of amount mentioned in 269T made in during the previous year. Again, if such repayment, whether such repayment is made by check or bank draft or any ECS through a bank account, details of the name, address, PAN, etc. has to be furnished. The limit shall be 20,000, and particulars of clause D talks about particulars of repayment of loan or deposit or any specified advance in an amount exceeding the limit specified of 269D for a mode other than by a check or bank draft or use of ECS, that is in cash basically. Clause E talks about, again, such amount is received by a check and bank draft, which is not an account pay check or bank draft. So somehow, if we notice, few of the times we have to give repetitive information also, but it has to be given in proper classification under clause 31. Clause 32 talks about details of brought forward losses. Details of brought forward losses, it is a very simple clause that the brought forward losses has to be reported under this clause, and such amount has to be rectified or revised considering the rectification order or assessment order. And if there is a change in shareholding, that is in case of closely held company or so, the provisions of section 79 has to be taken care of, that if there are changes in closely held company for more than 51% or due to the death of shareholder or any such conditions as given under those sections, then whether this carry forward of loss is allowable or not has to be seen with that context. Same way, if the entity has incurred any speculation loss, and such speculation loss is only to be set off against speculation gain and not any other such income, and such loss shall be carried forward only for 4 years. Basically, this clauses C, D, E will help to keep the check on those clauses. Sir? Hello?
Hello, yes.
Sir, considering the time limit, I'll just quickly complete. Yes, sir?
How many more slides are there for you?
Sir, if not detailed explanations.
Right.
Okay, sir, I'll represent my screen.
Right.
So, yeah. Coming to clause 33. Clause 33 requires disclosure for details of deductions. This clause requires reporting on section-wise details of deduction that are admissible under section under Income Tax Act. That is only regarding Chapter 6A, that is from section 80A to 80VV, and Chapter 3 from section 10A to 10AA. Reporting requirement is that the tax auditor needs to report the amount claimed as deduction and under which section such deduction has been claimed and whether such amount is admissible or not. Clause 34 talks about reporting on TDS. Reporting on TDS, this is a very important clause. This clause attempts to provide details on TDS compliance by the assessee. That may be on TDS deduction or TCS collection, maybe filing of TDS returns and the interest on defaults. In all such things, different particulars are to be mentioned. For TDS deduction and TCS collection details, TAN of the assessee, section under which TDS and
Nimisha, you can
TCS
skip
was.
34. I'll cover it.
Okay. So clause 35, quantitative details. These are very simple clause for a trading concern, for a manufacturing concern, for both the concerns, principal items for goods traded or the principal items of goods manufactured, that is raw material used or the finished products produced using those raw materials. Quantitative details are to be given, and these quantitative details can be easily available from the cost records of the company. Section 36 and clause 36 and 36A, that is dividend and deemed dividend. For the amount, in case of a domestic company, for the amount that as distributed as dividend by the company, and DDT on the same has to be disclosed categorically in the tax audit report, along with the adjustment, if any, from the dividend received from domestic subsidiary or foreign subsidiary. Second thing, clause 36A talks about the deemed dividend. Deemed dividend is nothing but as per the section 2 subsection 22 clause E, that is loans or advances made by the closely held company in lieu of dividend. So in that case, details of amount received as loans and date of receipt has to be considered while disclosing the details in clause 36 and 36A. Coming to clause 37, it is only the reporting requirement on cost audit and whether such cost audit was carried out and any disqualification or remarks made by the cost auditor. 38 and 39 talks about excise audit and service tax audit, whether such audit was conducted, and any remarks or disqualifications or disagreement related to any matter made by such auditors. Clause 40 talks about ratios. Ratios are basically to be considered from profit and loss account, that is the total turnover of the assessee, GP ratio, gross profit ratio, turnover ratio, net profit ratio, inventory turnover ratio, and material consumed to finished goods produced. All these ratios have to be computed, and so that it clearly demarks the profitability of the entity. Clause 41 talks about the details of demand raised or refund issued. Any assessment order received by the entity from the income tax officer regarding the demand raised by the officer or refund issued by the officer on the assessment cases going on the assessee shall be disclosed under this clause. Clause 42, reporting of specific form filing means there are different forms which are required to be filed by the assessee in case when there are specified financial transactions or any statement of reportable accounts in accordance with Foreign Account Tax Compliance Act, that is FATCA, and Common Reporting Standard, that is CRS, for any calendar year. In all these cases, if the entity has filed or complied with such form filing procedure, then details of such forms has to be reproduced in clause 42. Clause 43 talks about reporting by entity of an international group. So MNC's group working over here shall be required to give all these details, which shall more or less be covered by the transfer pricing audit as form 3CAC or 3CAE, that is master file and CBCR filing has to be given in this clause. Clause 44, last clause for the discussion, is breakup of total expenditure of entities registered or not registered in the GST. This clause merely attempts to provide a breakup of total expenditure, that is total expenditure incurred by the assessee, expenditure from GST registered entities, and expenditure for unregistered entities. Such breakup has to be given. But it is important to note that the applicability of this clause has been deferred up to March 31, 2021, that is for AY 2021 and AY 21-22, this clause will not be applicable if unless otherwise notified. Vedant, you may continue.
Yes. Can I get the screen sharing right, sir? A brief description about the tax audit. First of all, we discussed about basics of tax audit, whereby it is very important to understand the applicability, the structure of tax audit, the due dates, and the penalty. Correct. Moving ahead, if I talk about how the flow of conducting tax audit works, so basically due importance is to be given here to the appointment letter, the engagement letter. Say for example, after the appointment is being received, an appointment letter is sent by the client, whereas engagement letter is a letter sent by the chartered accountant to the client mentioning the terms and conditions on about the working of the assignment. Apart from that, at the end you have to take a rep letter, which is an MRL or management representation letter, the assumptions or the observations or the points that you have considered to arrive at your opinion, or to or the important noting that you have considered while conducting this audit, can be taken by way of management representation letter. Then there is commencement. Once the engagement letter is being received, you commence the audit. You ask the client for pre-filling the form 3CD and submitting you. On the basis of that, it is advisable on a professional side to prepare a checklist or a list of documents which can be sent to the client at the time of commencement, that this is the list that will require for carrying out the tax audit. So kindly keep these documents ready. It will help you to complete the audit in a time phrase manner and in proper documentation. Apart from that, if the accounts are audited by any other chartered accountants, then ask for audited financial statement and go for its review. Once that is being done, you can also prepare notes for the 3CD. As you all know that preparing 3CD is a pre-filled, a predefined format under Income Tax Act, but there is an option available to the chartered accountants to ensure themselves. Say, for example, before this uploading and digital platform for tax audit began, we used to write down certain notes at the end of tax audit, similarly in line of normal accounting policies, or some of the assumptions or the points that you have considered in the while reviewing this tax audit report. So I'll just show you that what all are those points. So apart from the signed balance sheet, can you see the notes appended? Hello.
Hello.
Yeah. So notes attached to tax audit report is visible, sir.
Yes, yes, it is there.
Okay.
Yes.
Okay. So a chartered accountant at the time of uploading the financial statement on the income tax portal after logging in, he has to submit an XML copy, one that is done. He has to upload the digital signature, that is done. He has to upload balance sheet. He has to upload P&L. But apart from that, there is another tab available, others, whereby you can put this note so that to safeguard yourself and to give more disclosures on your side to the department as well for more clarity. Correct. So this is the structured format which we as a healthy practice follow, whereby say in header we mention the client name, the relevant assessment year and previous year. It is named as note attached to the tax audit report, whereby we start with giving disclosures with regard to ICDS, which is very important under clause 13. So each ICDS we mention here similarly in line with financial statement, ICDS 1, ICDS 4, ICDS 5, be it ICDS 10. So these all are the disclosure requirements that we follow so that it gives a better clarity to the reader and to your side to safeguard that yes, these all are the points that we have considered for arriving at our opinion. Be it, for example, forms clause 16 or with regard to 21D, where cash payment under 48.3 has to be verified, or MSME related note, or with regard to even TDS or 31, where materiality point has to be considered. So you can mention these points, get it signed by your client as well as you can sign it, and then upload in the portal as well. So this is a very important note which you can follow. 34, 40 clause related to ratios. Say, for example, we have considered in line with the guidance note, or say, for example, as it is not manufacturing and trading, the ratios are not applicable. Any such kind of notes, you can put it here. And at the end, you can put your signature and submit on the portal. So this was with regard to the notes attached to 3CD. This is a very important document. If this practice is not being followed, I insist and suggest that this kind of practice will help in better disclosure and presentation of your statement of particulars. Then sharing of draft file with the client and receiving the approval in the process when coming back to it. You can share this file in draft manner. If client approves, we can go ahead with filing of the uh, return and the computation and the financial statement. Then CA has to upload. Then one important point that I want to draw your attention is KYC. KYC, as per recent code of ethics, doing KYC of client is also become suggested and advisable under the code of ethics. So my request is you can refer code of ethics, go what all requirements are there for the purpose of KYC and start preparing your KYC register. That will be very helpful to you in upcoming future. Correct. Now, not need to discuss as all this has been discussed already. Yes. Now, while the practical concern which I want to address is some of the 3 or 4 points which I have came across in my professional career and want to discuss with you so that you can also consider at your thoughts of wisdom. First is generally we see that in case of proprietorship or partnership or sometimes in companies, expenditure which are in personal nature but are presented that it is in the nature of an assessee. Say, for example, car expenditure, repairing expenditure. Matlab car, say, for example, petrol expenditure or repairing expenditure. Do you think that cars, which is in the name of the firm but used by the proprietor, will totally be used for the purpose of business? The answer is no. So it's a general practice you can use or reduce. Say, for example, total expenditure related to petrol is 10,000, out of which you can voluntarily deduct, say, for example, 2,000, 3,000, or 4,000, by stating that it is of the as the car can by not, it is not required to state specifically, but you can on yourself willingly disallow that expenditure, so that it gives an proper clarity on the nature of expenditure, that though 10,000 has been marked in books, but 4,000 we are disallowing, considering that it would have been used for personal purpose as well. So that is the first thing. Second, as far as clause 18 is concerned with regard to fixed asset chart, it please ensure that it is matches figure to figure, decimal to decimal with the income tax return details, because those two are preliminary going to be mapped with the statement of particulars and your income tax return. So that has to be aligned with. That was the second point. The third point, it is preferable to provide your PAN and address details under clause 31, which is with regard to 269 SS, because notices are directly issued. I have seen that in absence of the details, these are furgy or unknown persons on in whose name you have shown the transaction. So it is better to present PAN and the address so as to identify the identity of a person or an assessee. Further, it would have been observed that it is the section 269 SSRU is creating a lot of trouble in case of real estate industry, where as far as advances are received from customer and any refund, for example, there is a big builder who has 500 flats, so all those details are to be presented here. So that is going to be a burdensome procedure and to be taken care of. Apart from that, ratios, which has been discussed by Nimisha at the end, has to be compulsorily mapped with your financial statement. Ensure that the figures presented in ratios map with your last financial, which are signed financial figures. Apart from that, as I stated with regard to clause 34 TDS table, say for example, there is a lot of confusion with regard to these columns, what amount and where to be presented. So first is with regard to first column number is 10, normal, it is going to be unique. You can refer the 10 there of yours assessees. Then there is section, say for example, 194J. The nature of payment would be fees under professional or technical services. Now, column number 4, what does it state? The total amount of payment or receipt of the specified in column 3. So you have to refer to your PNL, go to your PNL, signed PNL, check that under the head of legal professional services, or if any technical services, what is the amount? Take that entire amount directly and put it here. Say for example, it is 100% of figure. So I have mentioned below the table in fourth column 100% under 194J. Now I'm going to fifth column. Total amount on which tax was required to be deducted or collected. So there are chances. Say for example, I am Vedant Parikh. My firm is Parikh and Associate Chartered Accountants. I have raised an invoice on my client of 80 rupees. And in the client's books, total expenditure for professional nature is of 100 rupees, out of which 80 is mine. So only on 80 TDS was supposed to be deducted. On that 20 TDS was not supposed to be deducted. So in the fifth column, you have to mention 80. Correct? That is clear. Now moving to sixth column. Total amount on which tax was deducted at specified rate. So it does not require the amount of TDS, but it requires that on what amount you have deducted TDS. But obvious 80 was required to be deducted, so we have deducted on 80. So there also sixth column amount would be 80. Seventh column, amount of tax deducted or collected out of 6. So here you have to mention the TDS amount. Moving ahead, so that will be 10%, so 8. Moving ahead to 8th column, total amount on which tax was deducted or collected at less than specified rate. So here in general cases, it will be 0 unless and until there are certain lower deduction certificate or certain nature of cases. Then only that 8th column and 9th column would be applicable. If I talk about 10th column, amount of tax deducted or collected but not deposited to the central government, out of 6 and 8, that is been presented here because it is a non-compliance which is eye-catching for the department. Correct? I hope I made you clear regarding the presentation of figures, because there is a lot of ambiguity. Even after reading the guidance note, we are not in a position to mention what amount has to be kept there. Yes, reference. Whenever we are doing tax audit, reference has to be can be taken from guidance note, which are available from the ICAI website. Standards on auditing, previous year tax audit reports and ITR, so as to see what pattern has been followed. Previous year audit file has to be checked, what working papers has been taken and any brought forward is there or not. and Income Tax Act can be referred at any point of time. Documentation. Yes, I was saying that I will discuss it, and documentation is very important, and that will cover first is permanent file. Prepare a checklist and collect documents and keep it intact. Second is with regard to current year file. With regard to clauses till 44, you have to clause wise. I insist that if we have anything mentioned in that clause, collect document clause wise. That will be very specific, very particular file. Even that will be helpful at the time of peer review. Retain and review copy of it. Then there comes peer review documents, which should also form part of current year file, which includes appointment and engagement letter, also MRL, which I stated. RECO of audit fees specifically has to be done, because sometimes we forget that what is the R fee and what is the amount to be claimed. That will be helpful at the end of audit. Materiality estimate has to be there, because that will help you to analyze that on what materiality grounds you have conducted the audit plan and program, persons involved, number of days given in the file, given for the assignment. So all these are peer review docs. So thank you so much. I, on behalf of Nimisha and me myself, can be reached on the details or contact details or communication details that is mentioned on the screen. Once again, we both are thankful to the Ernakulam branch, especially Varghese sir, for inviting us on your platform and giving insights on the topic. And we hope that we have been able to fulfill your requirement of enhancing your participants with the required knowledge on the tax audit topic. Thank you. Thank you so much, sir.
Roy sir, mute. Roy sir.
Yeah.
Yes.
Process.